store online. But what about some of the retailers in the secondhand areas and way in which you can buy?
In 2022, we saw many retailers and consumer brands standing up their own secondhand platform. So this is a bit different. You and I, as I think we're around the same age, tend to think of secondhand shopping as going into a big store and having to sort through some maybe slightly disorganized clothing racks to find those treasures. That has really become a much more digitized experience, which of course is really attractive to our Gen Z and millennial shoppers. Most people shop secondhand to save money, but certainly the sustainability angle or finding something really cool and unique are also motivators for shoppers. So as inflation continues to hamper consumer budgets, we have seen more shoppers take to secondhand shopping. Specifically, we're seeing this more from women, especially those who are a bit more financially strapped, have really accelerated their secondhand shopping. And then when you see big brands, like Timberland, Athleta, Lululemon, all have stood up their own versions of secondhand shopping, whether that be through their own hosted peer-to-peer platform or actually, through more of a consignment model where the brand is really authenticating and maybe refurbishing some of these items before resale. That can make it feel a lot more accessible and a little more certain, I might say, for a shopper who's worried about things like quality and authenticity in the secondhand market. So I think the investment that retailers have put into secondhand has really made the market poised for a lot of growth in 2023.
Claire, I know one of the big themes in retail over the last decade has been reducing the number of stores in this country, in America, kind of reducing the footprint. Where are we now in that process? Is there still more room to go, or has maybe the pandemic kind of accelerated that whole process?
The pandemic certainly accelerated. It's important to remember that the US specifically was massively overstored in terms of square footage of retail space per consumer. So we had a few too many stores, or at least too much square footage of real estate for a while. So what we've seen is really a rebalancing. We've also seen a lot of great stories from brands like, Dollar General's been a big hero of reopening or opening additional brick and mortar spaces. So it's really been about moving some stores around, making sure they're in the right places for consumers. But one trend that I think is really exciting is all of these digital direct-to-consumer brands, part of their growth phase does include opening brick and mortar. So the utility of brick and mortar for the American shopper is still very much alive and well, but there has been some real estate reshuffling that's needed to happen to ensure that brands have stores in the right spaces and at the right size.
And come and do pickup and the like. I'm interested more broadly, Claire, here in the haves and the have-nots, the bifurcation of this market. It really felt as earnings started to come out and as we started to see this economy slow, people still could buy luxury because, let's face it, inflation tends to hit the lower income demographic, and those that perhaps more depend on the stock market get hit a little bit, but in general, they can still continue to purchase at the higher head price points. Then people trading down. Who's best place as we go into 2023? Is it the cheaper stores and the very high-end ones? What about that sort of painful middle?
The murky middle or the mushy middle is absolutely where we're seeing the most pain. Those stores that don't really have a differentiated promise or experience for their shoppers are where we see that there's just not a strong reason to buy for those shoppers who are looking for something in that mushy middle. The only real motivator there is going to be discounts and convenience that get people to your store, which, from a marketing perspective is pretty boring and not a lot of fun to play with. So we've seen even brands like Walmart in recent earnings have said that they've done a good job of capturing higher income shoppers. We know the luxury market has, of course, been really well insulated from this. And then I'll go back to brands, like the dollar store families who are really who have captured a lot of shoppers where there's been a lot of disruption in terms of the stores that consumers are loyal to. So where people have been able to be more competitive on price, there has been a sort of continued hollowing out of that middle of retail.
All right, great stuff. Really appreciate you taking the time. Claire Tassin, she's a retail and e-commerce analyst at Morning Consult, joining us via Zoom from Chicago. Pretty decent consumer still out there in the marketplace, supported by a number of items, including effectively full employment out there. Coming up, we need to get the latest on China. More news coming out of China. They continue to reopen, and I think this reopening, the pace of the reopening, caught a lot of people around the world a little bit short or flat-footed here. So we're going to get the latest there. Can the Chinese folks, can they leave China and come to other parts of the world? We'll see. We'll get the latest coming up. This is Bloomberg.
We were thinking big from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Back to Bloomberg Markets Live. We are across radio and TV for your last day of trade of 2022. Paul Sweeney, Caroline Hyde. And what's been really interesting is the only places to hide this year, it's not been equities, it's certainly not been bonds. The dollar has continued to be an outperformer, but that has been painful for the emerging markets. I mean, it's been painful for the emerging markets for nigh on a decade now, but it's interesting as we start to see this reopening trade, particularly the news of late of China, the U-turn. I wonder if we start to see a reprise in the emerging markets and a rise in global growth more generally.
Yeah, we're going to talk about that in just a moment. We're going to check in with someone from HSBC who does that stuff for a living. But I need it. When you talk about emerging markets, you got to get a call on China. And boy, the news has been coming out of China. When they do a reopening, they're not messing around, folks. They go all in. We want to get the latest. Madison Mills joins us here on our Bloomberg radio studio. She's from Bloomberg News and Bloomberg First Take and all that good stuff. Quick take. Madison, what's the latest news out of China? It's just amazing, the pace of their reopening and the reaction that the rest of the world has to make.
Yeah, I made the huge mistaken news of requesting a slow news day today as we head into New Year's Eve and look at where we're at today with China. Starting off with the big news this morning, Vladimir Putin and Chinese President Xi Jinping, of course, having their video conference, their first meeting since their in-person meeting in September. I think the big news to come out of that is what we heard from Putin, really more than what we heard from Xi Jinping, saying that, Russia and China ties are the best in history, that their strategic partnership is a stabilizing factor amidst broader geopolitical tensions. What I'm looking at, though, is kind of what we didn't hear from Xi Jinping, still not hearing any massive support of Russia's attempts in that war in Ukraine, and still not hearing him even calling it a war.
So the geopolitics remains front and center for every investor going into 2023. So too does the health side of the equation and the reopening of China. Where do we stand in terms of where is worried about Chinese travelers coming in, where's looking for restrictions in some way?
Yeah, so we heard Italy earlier this week calling for more restrictions on those travelers coming in because there were so many positive COVID cases on those flights going into Milan. We even heard as of this morning, 10% of people on a flight from China into Rome also testing positive. What's interesting is they're not showing symptoms, and as they've sampled these test results, we're seeing that it is the Omicron variant, which is good news for everybody because that could mean that we have some herd immunity and our current round of vaccinations work against that. But the case counts in China itself are just astounding. It's very difficult to get a sense of those case counts because of the lack of transparency around the data, but we're hearing numbers in the hundreds of thousands of positive tests a day, potentially up to 25,000 deaths as well in one day coming out of China.
So where are we with the data? As you call out, it's not very transparent, and I guess no surprise there, but is there any third-party independent means to get any of this data? I think about even the Chinese Beige Book people who have those people on the ground getting real economic data. I just wonder if there's any way to get a sense of this, because this could just be astronomical or not. Maybe they are more vaccinated than we think. Maybe their vaccines are better than we think. I'm just not sure kind of how this could play out in January and February.
Yeah, it's the question to ask, Paul. I think the reporters that we have on the ground in China are doing their best to, get information that they can from WeChat groups. Local city health commissioners are really doing a lot of work to get the information out. There are also some key indicators that you can look to, like pharmacies running out of cold medicine throughout China, that shortage being an indication of a lot of positive tests as well.
A great story on the terminal today, Paul, using Airfinity, it's a UK-based research company who were saying, look, come the peak of Lunar New Year festivities, we could see deaths of 25,000. At the moment, I think they see about 9,000 deaths a day. Guess how many the Chinese are reporting a day?
A fraction of that.
12.
Yeah.
Extraordinary.
12.
Well, we thank for the transparency that we get with one Madison Mills, who comes on to talk us through all the latest, whether it's geopolitical, whether it's reopening. And this, of course, feeds in wonderfully to a discussion about what the reopening of China, as messy and as ugly as it currently seems for the people on the ground there at the moment, what does it mean more broadly for emerging markets, for a global economy? We do that with a doctor in the house, in fact, a PhD holder. Murat Ulgin's with us, we're pleased to say. He's from HSBC, Global Head of Emerging Markets Research. And Murat, wonderful to have some time with you. And we were discussing sort of some of the reopening trade, the discussion around China. What does that mean in terms of Asia more broadly and a desire to want to be going long emerging markets in the space?
Sure. Well, thank you very much for having me, first of all. I think it's a good place to start with the findings of our latest emerging market sentiment survey that we conduct on a quarterly basis across global institutional investors for all walks of life, FX rates, credit, and equity. The previous survey, it's a quarterly one. The previous survey, when we released it in September, we've seen a very downbeat mood for emerging market investors. But the survey we recently released a couple of weeks ago for December actually shows a distinct improvement in sentiment for emerging market investors. The net sentiment, bullish versus bearish, has turned positive for the first time since July 2021. We have seen emerging market investors willing to put cash to work in 2023. This is the first improvement in 5 quarters. We ask investors, what is your current appetite to take emerging market risk? At this juncture, with 0 being no risk and 10 being full risk in EM, that score has also improved. Obviously, the news about China reopening and supporting its property sector they're helping with the sentiment, but it's also the fact that we've seen some improvement in the inflation outlook across the world, obviously in the US as well. And that is also helping with the expectation that the global central banks, led by the Fed, is nearing the end of the tightening cycle. And these things actually are painting a relatively better picture for emerging markets. I'm saying relatively because last 2 years, I mean, 2022 and last year, 2021, we've had emerging market financial assets performing negatively across the board, 2 consecutive years of negative returns, and things are looking a little bit better, relatively speaking, based on our survey.
Murat, I'm not an emerging markets investor, but I step back and think about 2021, 2022, and I think about what's going on in China with the reopenings, the closings, the reopenings, the harsher regulatory take by the government. I could step back and say, I don't even think China's investable. But what do the professionals, the emerging markets professionals, what do they really think about China?
Well, look, actually, in our survey, the expectation about China growth has picked up, and China is one of the equity markets that investors single out, alongside with Indonesia and India when we talk about Asia. The first and foremost region they would like to invest is actually Latin America across the board, including fixed income. But for FX and equities, more so over fixed income, it's actually Asia, and China features in there. Look, I think, the beginning phase of reopening will probably bring some volatility. It will be possibly bumpy. Our economists are expecting some volatility in output, actually, and we're seeing the latest data being on the soft side, but they do expect a significant upswing in the second and third quarter of next year. A very strong Q-on-Q improvement. Yes,
You say you're looking at data. What data do you like to look at when it comes to China more broadly?
Well, obviously, we follow the sentiment indicators like the PMIs, the official one, and the one for the private sector involving more the exporting side of the economy, but also the hard economic data, fixed asset investments, industrial production, retail sales, all sorts of data. And again, their expectation is a relatively soft start in the first quarter of next year, but then a significant upswing. They're actually looking for a V-shaped recovery in consumption with nearly 8% growth in 2023, which should help activity, because so far last 2 years, it was the external sector, production and manufacturing and exports helping China. But with the reopening, albeit probably bumpy in the beginning, later in the year, second and third quarter, the expectation from our side is consumption should start helping.
Murat, a lot of my Indian friends have been telling me the next decade is going to be the decade of India for a variety of reasons, not the least of which is because China is having so much trouble with its COVID policy and so on. What's the call on India longer term?
Yeah, the longer term call is really brilliant, I have to say, because our economists have done a great report, World in 2030. They've done it a couple of years ago, and India is the country that jumps the most in global leadership board in terms of its overall GDP and GDP per capita. And obviously, we've seen significant reform efforts in India a couple of years ago, from goods and services tax, demonetization, remonetization, banking sector overhaul, etc. It has demographics, it has an educated population. I think the medium to long-term outlook is really great. The near term, again, some volatility perhaps could be expected because, obviously there's lots of investor positioning in there, especially in equity market, with the expectation of this great long-term story. But also at the same time, inflation is rather high. I mean, the latest inflation print was favorable, but core inflation is sticky. And, India is a major energy importer, especially oil. So they're probably not completely done with their tightening cycle. So they should probably have to get over the inflationary curve, which we expect sometime early next year. Yeah. So that could bring a bit of a volatility in the beginning. But the long term, since you asked the long term, it's a very, very bright future based on our expectations.
Going back to your expectations, the HSBC Emerging Market Sentiment Survey, clear and simple, LATAM, the most preferred region. Just talk to us about within that, break it down a bit and the reasoning why.
Yeah. Absolutely. I mean, the 2 markets that really stand out are Brazil and Mexico. And I mentioned Asia in the context of more FX and equities, whereas Latin America is probably across the board, all asset classes, including fixed income. I think part of the reason is Latin America was the first in the tightening cycle. Brazil has started hiking rates 1 year before the Fed. And, Mexico has also delivered substantial rate hikes in tandem with the Fed. They're both now seeing their inflation turning down, especially in Brazil with a very big downside momentum. And economic activity will likely be supported with a potential for actually cutting rates, which we expect in 2023. Sentiment has improved. The external sector, the current account balance is pretty good. And when it comes to Mexico, there is all sorts of this, FDI flowing into the country. In the first 3 quarters of this year, with $32 billion, Mexican FDI has broken a record ever. Strong inflows of tourism, remittances, they're all also helping the currency as well. So these 2 particular markets are really singled out by investors, but investors generally favoring LATAM because LATAM is a lot earlier in the tightening cycle, and also the external balances, thanks to the previous commodity rally, is really in a pretty good shape.
All right, great stuff. Appreciate the update, Murat Ülgen, Global Head of Emerging Market Research at HSBC. Their survey work showing investors getting a little bit more optimistic about emerging markets in 2023, perhaps ready to take on a little bit more risk there. And China, obviously the big wild card. It's a big part of the MSCI Global Index, as goes China, as goes a lot of the emerging market space. Right now, let's get world and national news in London with Ritika Gupta.
Thanks, Paul. The U.S. may give Ukraine's ground fighting capabilities a boost. Bloomberg's learned the Biden administration may send Bradley fighting vehicles to Ukraine as part of another military support package. The Bradley is used to transport troops, but it's also armed with missiles and a 25mm gun. In Myanmar, Bloomberg's learned that deposed leader Aung San Suu Kyi has been sentenced to 7 more years in prison after being convicted of corruption. It was the final round of verdicts against her since the military ousted her democratically elected government in a 2021 coup. Suu Kyi's total prison term is now 33 years. And here in the UK, home prices fell for a 4th month. That's adding to concerns that a deeper slump may now be underway. Nationwide Building Society said its measure of property costs dropped 0.1% in December. Meanwhile, a separate report from Halifax showed demand for homes falling in London and strengthening outside major urban areas. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Caroline.
Ritika, thank you so much. And where Ritika sits over in London, the day's trade was done hours ago. The FTSE closed. Yeah, good for them. Good for them is because they actually eked out a growth for the year in terms of the FTSE 100, not in dollar terms, but in pound terms. They did manage to close up 0.9% on the year, so just. But we do see everywhere else there's drawdowns. The DAX closed early. It also was down 12% on the year. On the day, it was off by more than a percentage point. Europe closed up shop with every industry group in the red for the day. In fact, it was mainly technology, telecoms, and those sorts of companies that were on the downside. But Europe down by, what, 12% on the year? Not nearly as bad as global stocks.
No, and I'm thinking about Europe. I think about some of these big, great European technology companies like Siemens and the big manufacturing companies. They got to be loving this reopening in China. I mean, that's got to redo their 2023 budgets, because if in fact China is reopening, that I know they have a lot of export business to China. So for a lot of
tell you another key set of European names that will benefit. LVMH.
Yes.
Some of these caring groups, the luxury companies, they're going to be willing these Chinese spenders to be coming back to Paris, to Rome, to London, to here in New York to do a little bit of luxury spending. Not much luxury spending in terms of your stock market today, though. This is Bloomberg.
Most of us don't spend much time thinking about the grid, the dizzyingly huge system of cables, transformers, and outlets that reliably powers our lives. It's an easily ignored, change-resistant part of the modern world, and that's the way we like it. But as we move towards less planet-melting ways of producing electricity, the grid is going to have to evolve too.
We're seeing so many countries and governments announcing high targets when it comes to decarbonization and being climate neutral. But this is just one side of the coin. It's not enough to simply generate green energy. We also need to make sure that this is transmitted and distributed to the end consumers.
The grid of today just isn't equipped for renewables. So a new kind of grid is starting to take shape. The supergrid.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Count Under the Close.
Welcome to Bloomberg Crypto.
Bloomberg Markets Live, simulcast to you on radio and TV with Paul Sweeney, Caroline Hyde, and one Abigail Doolittle in the house to run us through what has been a disastrous year for bonds, for stocks, the dollar having a pretty torrid time since June, but it is clean to gains. But talk to us about what really caught your eye for 2022.
Well, I think you just grabbed it all, Caroline. I mean, it's been the volatility. I mean, it wasn't unexpected at the start of the year, but it has really been incredible. Not so much in terms of measures of volatility, such as the VIX, but these incredible stock moves, because there have been so many moves up and down for the S&P 500, very similar to the bear market of 2000 to 2003, where there's lots of false hope. But maybe that those moves, the move higher in bonds, the move that we've seen up in yields, down in price, commodities at the same time higher, which is not something that you would typically think would happen when there's fear of a global recession, a demand problem out of China, and then also with stocks higher, so a real divergence. And then, of course, there's crypto. You have Bitcoin and the complex down in a big way. And I think, Caroline, you were just saying Bitcoin down about 64% on the year. Will next year be a brighter spot? Well, we'll have to wait and see.
All right, good stuff. Abigail Doolittle covering all the market stuff for us here in our Bloomberg Radio studio. Let's keep on that crypto story. We need an update. We need feels like we need a daily update on all things crypto. There's so much cross current of news flow. So let's start off with Hannah Miller. She is Bloomberg News. Hannah, I mean, Bahamas seized $3.5 billion in FTX assets on custody concerns. That's the headline I woke up to this morning. What's the latest?
Yeah, so that gives us more insight into what's happening here, because there was this $372 million theft of assets from the FTX exchange shortly after the company filed for bankruptcy on November 11th. So there were these cybersecurity concerns, and it makes sense that Bahamian authorities made this seizure.
What's so fascinating, of course, is the 150 entities or thereabouts that filed for bankruptcy within the FTX filing. And I'm reading today that FTX Japan apparently is going to allow customer withdrawals from mid-February. So interesting that almost Sam Bankman-Fried built his reputation at FTX, at Alameda Research in particular, with that arbitrage between trading crypto in Japan and trading it in the US and being able to make money, perhaps not as much as he declared. But talk to us about the global nature of this at the moment, where SBF is being taken to the task, legally speaking.
Yeah, we know SBF and FTX's reach was extremely far. This was a global company with entities around the world. So there's a big question here of which customers at which exchanges are going to get their money back first. And we've had insight from John J. Ray, who's handling the FTX restructuring, that US customers might be, further ahead in line, let's say, in terms of getting back their assets.
So do we even know? I mean, he has not even entered a plea. What's the next step in the legal process for Sam Bankman-Fried?
Yeah, so we are expecting him to enter a plea at his next hearing, which is on January 3rd, so coming up soon. It seems like there might be pressure on him to enter a guilty plea, and that is because his FTX co-founder, Gary Wang, and the former Alameda CEO, Caroline Ellison, have already entered guilty pleas, that they are cooperating and working with authorities in terms of, providing evidence of what happened here with FTX.
Hannah Miller, we hope you get some rest and some celebration for New Year's Eve, because unfortunately, as many in the crypto space know, it does not sleep. We hope she gets some fun. Thank you for bringing one with us. For all things FTX and Sam Bankman-Fried, as we wrap up the year that was, of course, an issue for that space, but the contagion effect, whether it was the tail wagging the dog of quite often you saw crypto sell off because the overall NASDAQ was selling off, and then maybe you saw the NASDAQ fall off because of some of the worries of contagion from crypto. We can talk all things technology with the one, the only, Ed Ludlow, who still works for us late in the United Kingdom. We love him for it. I'm pleased to say as my co-host of Bloomberg Technology as well when that's on live. Talk to us about what a wipeout, basically, technology longs had this year.
Well, it's funny, I got a bit of a holidays quiz for you guys, and I was thinking about this in the break, looking on my Bloomberg terminal. You guys tell me, when was the low of the year on the NASDAQ 100?
Was it quite recently?
Come on.
Was it like November?
Quite recently.
Wasn't it your birthday, Ed? I feel.
Well, that was, so we eclipsed that low on Wednesday. So on the 28th of December, we hit low. Do you guys know when the high for the year on the NASDAQ 100 was? Come on, you must
January
know.
2nd.
Well, that was a Sunday, Paul, but January 3rd. And that's my point, is that we reached the heights on this index on the first trading day of the year, and we hit a fresh low just the 3rd from last session. And that kind of sums it up, doesn't it?
Yep.
That this sector broadly, and there's a lot within that, was the main victim when it comes to, aggressive rate hikes from central banks all around the world. And also, you can't separate the stocks and the bond story, right? Because the rise in yields makes those tech stocks so much less attractive. And it's been a year, my goodness.
So, Ed, we've been asking a lot of the experts about this sector, the tech sector, and whether it can be a leader in this market as it has been for much of the last decade. And I'm not sure if it's just rising interest rates, which certainly hurt the tech sector in the first half of the year.
Yeah.
But in the back half of the year, a lot of them were taking down their forecasts, their estimates, saying, hey, we've got some headwinds here. And that called into question their ability to kind of plow through a recession. So I'm just not sure kind of how people are looking at this sector right now.
Yeah, I think I always go to forward 12-month price to earnings, right? In other words, earnings expectations, and those have really come down since September, October by, 4 or 5% across the tech sector broadly. Why? Well, many of them did give, tepid is a bit kind actually, they gave weak forecasts for the current period, which is the 3 months ending December, and very little outlook for the first 3 months of calendar 23. So whether we do have a hard or soft landing, I think the bigger concern from markets around the tech sector is an earnings recession, right? Where we do see weak earnings, at least in the first few months of that year. And so it's hard to call a bottom, particularly on the NASDAQ 100, which has, yes, your mega caps, but also those higher multiple software stocks, which are, have kind of weak earnings anyway, because they are either very early revenue or very pre-profit type companies.
What's interesting, Ed, this week at least, has been perhaps a slight change of narrative, some clinging to hope when it comes to those ADRs of the Chinese big names, and particularly Tencent getting that sign off on some of its games made people think, okay, not just a Chinese COVID U-turn, but maybe a bit of a U-turn when it comes to regulation, to the tamp down that has been on some of big tech names.
Well, all performance is relative, right? But I think I'm right in saying the NASDAQ Golden Dragon China Index, which is that sort of basket of US-listed China tech shares, is down 25% year to date, which is bad, but it's just not as bad as the NASDAQ 100 or the NYSE FANG Plus Index, which does include some of those names. The worry is for US technology companies, particularly the hardware makers, is they get hit on both sides of the equation, right? So if you look at Apple in particular, December was the worst month for Apple for 4 years. You have to go back to May of 2019 to see those kinds of declines. They got hit on the supply side because disruption for production in Zhengzhou from the spread of COVID and demonstrations. Now they're getting hit on the demand side as well because the spread of the virus is impacting the Chinese consumer. It's just a really critical story. There are some bright spots, though, that we got a lot of positive surprises from China e-commerce in particular, which is really kind of closely tied to that reduction of restrictive policy and reopening of the economy there.
Ed, go global for us each time. We love it. And all things are relative. But for you, you are our friend. Thank you so much for bringing us up to speed across the board.
Happy New Year.
Happy New Year. Have a great one. At 7 p.m. New York time, he'll be partying hard over there on Saturday. Let's have a quick look at what has been, though, not just a 33% sell-off in the NASDAQ over the course of this year, but the S&P gets away, lightly unscathed with just a fifth of its value being eroded. But globally speaking, that's exactly the same.
It is. It's been, and there's no place to hide. I mean, we had fixed income. You think about that 60-40 portfolio where 40% of my portfolio is in fixed income, which should kind of be a little bit of a hedge to the equity risk. But boy, they were down double digits as well, too. And we just haven't seen that before.
And I think sort of some of the narratives, the superlatives that we love to use on these sorts of days, the fact that, yes, it was the worst day since 2008, the worst year for 2008 for global stocks, but for global bonds, worst year in some measures since 1990.
Yes.
Just the people who trade this, who invest in it, the people on the desks, me, we've never experienced this before in our working memory.
No, absolutely. And you think about it, there was just no place to hide. And so a lot of people are saying, given that underperformance in fixed income in 2022, boy, a bullish case can be made for 2023. I'm starting to hear more and more of that. But like I told my kids who've recently been started working over the last 4 or 5 years, they have a 401k. I said, you got to look at the long term.
Yes.
This was a bad year. 2020 was a good year for you. 2021 was a good year for you. Now you got to pay back a little bit
Maybe
here.
a better entry point. You got to take a glass half full kind of a perspective. And I mean, to that point, where has been the outperformers? Where perhaps might pull back? What's interesting, I'm not still hearing much of a bearish case for commodities yet, particularly with China's reopening. Bloomberg Commodity Index has been one of the winners of the year.
It has been. I'm looking at WTI crude oil. We're at $79 a barrel. Where do we go next year in crude and some of those other commodities?
It's a shame. I've really enjoyed
This is
week.
fun. Yeah, we'll do some more of this.
Thanks for having me.
Yeah,
it's
likewise.
been a joy to be in this radio bubble. Wishing everyone such a happy new year. From New York, this is Bloomberg.
So you've built a successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is like you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And like frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct to consumer. Like I want to build out a true consumer empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one. And through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
From the world of politics to the world of business, this is Balance of Power with David Weston.
From Bloomberg world headquarters in New York, to our television and radio audiences worldwide, welcome to Balance of Power. We begin today up on Capitol Hill, where the House Ways and Means Committee this morning released some 6 years of tax returns from former President Donald Trump. And to bring us up to speed on what we learned, particularly what we learned that we didn't think we already knew, we turned on to Laura Davison, who reports on Congress and on taxes for Bloomberg. Laura, thank you so much for being here. What did we learn that's new at this point, or do we know there's so much of them that maybe it takes a while to pour through them?
Well, we're still going through it. It's about a gigabyte worth of data of all the returns for both his businesses as well as his personal returns here, thousands and thousands of pages. But some questions are already being raised. One particularly in 2020, it looked like he didn't claim any charitable deductions. And this, of course, after he pledged that he was going to donate his presidential salary, $400,000 away. In previous years, he did, but that last year in office, he looks like he didn't hold up that pledge. Other things that are also raising questions as well of just the massive size of some of these deductions that he claimed. Congress's nonpartisan tax experts have already reviewed this. They put out a report last week that showed that a lot of these things would be audit triggers. It's unclear whether the IRS is currently auditing Trump, but if they are, these things laid out here, dozens and dozens of kind of questionable tax moves, could be a roadmap for the IRS.
Laura, do you think this is going to change anything on Capitol Hill when it comes to auditing presidents, or for that matter, disclosing other people's tax returns? There's a lot of talk about that both ways.
Yeah, House Democrats put forth a bill that passed the House last week that would require the IRS both to audit and then release the results of that audit, including the tax returns of all presidents. It didn't pass with much Republican support. Republicans take over next week in the House, so unclear that that bill really has any momentum forward. But in terms of releasing tax returns, this is something that Republicans have already hinted that they would be interested in doing going forward. Kevin Brady, who's the top Republican on the Ways and Means Committee, said that this really sets a precedent to release the tax returns of private citizens or more high-profile people like Supreme Court justices or other lawmakers.
Laura, let's turn from what the Congress might do in the future to what they've already done. That's that omnibus spending bill that President Biden has now signed into law. Tell us about how big that is. Are we going to have anything close to that as big in this new Congress, given the fact we have a Republican majority in the House?
Yeah, this is a $1.7 trillion bill, and one of the reasons that they wanted to get this big bill done now is because House Republicans are taking over, and there's a faction of Republicans who really don't want anything near spending levels like this. That's going to be a huge fight going forward, and both in terms of the top-line spending number as well as some of these smaller issues, like we saw money for Ukraine in here. Mitch McConnell wanted to get this money in there, but Kevin McCarthy on the House side was a little bit more hesitant. This is going to be, a fight that is really going to characterize next year. The debt ceiling debate will be coming up. The U.S. will be hitting that mark at some point, Q1, Q2 of next year. Republicans are already looking to curb spending, whether that be, entitlement programs like Medicare or Medicaid, as a part of those negotiations to negotiate for lower spending going forward.
Yeah, another busy year in Congress ahead of us and ahead of you, Laura. Thank you so much. That's Laura Davison, who reports on Congress and taxes for Bloomberg. We want to focus in specifically on something we just heard about, and that's that money in the omnibus for Ukraine, some of the support that has been given already by Congress, by the United States government to Ukraine. At the same time, President Zelensky went to Congress and said he needs more yet to come. To give us an update on Ukraine, what needs to be done, we welcome now Kay Bailey Hutchison. She's the former U.S. ambassador to NATO. Before that, she served, of course, as Republican senator from Texas. So, Madam Ambassador, welcome. Happy New Year. Great to have you here. Give us your sense of what's going on right now. We saw that massive set of missile strikes in Ukraine overnight, second day in a row.
Yes, clearly Putin is doubling down on the civilians in Ukraine, incredibly going after electric grids and trying to make it more miserable in a miserable winter. And the cruelty of this assault is just unspeakable. And I think it has just been such a grinding, grueling experience for the Ukrainian people, who have stood it with such spirit and commitment. It's really unbelievable in 2022 what we have seen.
And as you suggest, it doesn't look like it's going to get easier. If anything, it may well get harder. President Zelensky, in addressing Congress, was not shy about saying that this next year could be a turning point, but he needs more. A lot has been given him, and he thanked Congress for that, but he said he needs more, and people have focused specifically on fixed-wing aircraft, longer-range missiles, and also more sophisticated tanks. Is he right? We're giving the Patriots now, but we did that a little bit begrudgingly.
we definitely, he is right, totally right. And he is there fighting for his country. His people are dying and suffering in his country. And he is so right that we need to keep our commitments to this freedom fighter and for this country as a part of Europe. I will say that that what we're giving is good. We have done well, but we could do so much better. And the things that you have just mentioned, I think, are essential. I think we need to give Putin or give Zelensky the ability to show Putin that he can take out the genesis of where those drones are coming from. We ought to be able to see that Ukraine can take out some of those launching pads so that they don't have to deal with them in the air where they're getting a good percentage, but not 100%. And taking those missile sites out, I think, would be very helpful, and being able to have the Patriot, of course, is a better defense, but we also need to help them with the offense that they're doing, both in their own country and also in the military assets that are attacking them.
Madam Ambassador, as you say, the United States has been, and NATO has been very supportive of Ukraine. The question is, should there be more? And I see, at least in the commentary right now, a question of, should we be playing to tie or to win? And it's quite a different question if you play to win. I guess my question to you is, if it is fixed-wing aircraft, more sophisticated tanks, it's longer-range missiles, if we went that way, we being the United States, would NATO come along with us? What would that do to countries like Germany?
I do believe that NATO will go along with us. I think NATO has been enlightened by the cruelty of Putin. They tend to want to try to work with Putin to get the energy in the past, to accommodate this big neighbor that they have. But now their eyes are wide open, and I think that doing more to help Ukraine have a decisive victory is our goal, and it's NATO's goal, and that needs to stay the course. We cannot flinch now because it's a message to Putin, but it's also a message to President Xi in China that we're not going to wane in our interest in supporting sovereign countries with democracies that are being invaded by autocrats.
You know, Madam Ambassador, the ins and outs of Europe far better than I will, and it's always difficult when you're talking about several different sovereign nations. But I wonder overall, has Europe pulled closer together or not? On the one hand, we see a lot of support from places like Germany and France, no question about it, for Ukraine. And also I noticed that Croatia is now going to join the European zone. They've been in the EU as of January 1. At the same time, for example, Hungary doesn't seem to be on board. Is there a difference depending on which country you're talking about?
Yes, there is. There are certain differences within Europe about intensity and what should be done. And a lot of it is some energy independence that is still there in some of the countries. But NATO is staying united and strong. And I think President Biden has produce that, and it's important that we keep that. But I think we need to do more. I think we need to be more aggressively helping the Ukraine people who are fighting for themselves. You know, we're making a big financial investment, but we have not put our troops on the ground. We've supported their troops on the ground. And I think that is a worthy goal that we should keep the commitment to achieve.
So as you know so well, it's not just Russia, Ukraine, and NATO plus the United States. There are other countries that are really involved around the periphery. Tell me about China, because we saw that report about President Putin's virtual meeting with President Xi overnight, in which they once again sort of pledged their troth to one another. Remember, we started the year with President Xi saying that our friendship knows no limits whatsoever. I'm not sure that played out in fact.
I think President Xi is walking a very fine line. He wants the energy that he is buying from Russia, and he needs to have that for his own domestic economy. But he knows that if he goes too far, that he will get sanctioned by the U.S., and he does not want that. So he's walking a fine line, but clearly he's not making the all-out commitment that his words speak, but his actions do not produce. He knows that Putin is weak. He's seeing this pathetic army with really run-down equipment, and he's seeing a terrible leadership vacuum in the prosecution of this war. And so I think he knows that having Putin as a great ally is not a big asset for China, other than the energy that he is buying from Putin. So I think he's walking a fine line. While he's saying the words to Putin, it doesn't appear that he's going all out, because he knows that the whole West is allied against Putin and against the atrocities of this war. And I think that, once again, Xi looks at his own economy and his own well-being, and trading with the West is uppermost in his mind. And I think he's going to protect that at all costs.
Madam Ambassador, thank you so very much. Really appreciate you being with us. That's Kay Bailey Hutchison, former U.S. Ambassador to NATO, as well as former U.S. Senator from Texas. And now, to keep you up to date with news from all around the world, we turn to Lisa Mateo here with the first word.
Thank you, David. We're sticking here in China. Some startling estimates of just how bad that COVID outbreak in China could be. According to London research firm Air Affinity, there could be as many as 25,000 deaths a day. Daily infections could peak around 3.7 million cases from the virus during Lunar New Year's celebrations next month. It has been difficult to obtain accurate data since COVID zero policy was lifted. China has named its ambassador to the U.S. as the new foreign minister. The appointment of Qin Gang is viewed as a sign that Beijing is moving back to a lower-key diplomatic strategy. Qin has delivered some of China's most moderate messages on hot topics, such as the war in Ukraine. Former cryptocurrency mogul Sam Bankman-Fried held at least 4 meetings with senior White House officials this year. It was part of a push to influence crypto policy and build connections before his FTX empire collapsed. FTX's ties to Washington have come under scrutiny since the exchange's collapse. Bankman-Fried gave millions of dollars to Democrats. And in Canada, the merger court has cleared the way for the union of 2 of the country's biggest telecom firms. The Competition Tribunal ruled in favor of Rogers Communications' $14.8 billion deal with Shaw Communications. The ruling said the federal antitrust commissioner failed to prove the merger would cause significant harm to competition. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg. David.
Thank you so much, Lisa. Well, come Sunday, we have a new year beginning, and come next Tuesday, we have a new Congress. The question is, what will happen in the new Congress, particularly with a different majority, Republican majority in the House? We're going to ask that question about the Republican agenda of New York Republican Congresswoman Nicole Malliotakis, what we can expect when her party becomes the majority in the House next week, and how will they get accomplished? And by the way, who will lead that caucus? That's all coming up next, and this is Balance of Power on Bloomberg Television and on Bloomberg Radio.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg.
it means they have a Bloomberg.
This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. Once we get past the New Year's celebration, come Tuesday, January 3rd, we'll have the beginning of a new Congress in Washington. And it will be a different Congress, specifically in the majority in the House of Representatives. It's a narrow majority, but still the Republicans will take over and control the majority in the House of Representatives. To give us a sense of what to expect out of that new majority, we welcome now Representative Nicole Malliotakis, Republican of New York. So welcome back. Happy New Year to you, Congresswoman. So give us your sense of what you're expecting for the Republicans, the agenda to be going forward.
Well, we believe that a lot of the crises that we're facing right now were created with policies under one-party rule. Everything from the anti-energy policies to the lack of border security and the dismantling of what we had in place that stemmed the flow, in addition to the spending that has just worsened inflation. We think this is our opportunity to backtrack, return to some sense of normalcy and some sense of balance, which I think is incredibly important what the American people wanted. I think, look, for us, our priorities are to get border security. We cannot allow millions and millions of people to continue to enter into our country illegally. We must stop the flow of fentanyl that is killing Americans, that the DEA is telling us is coming from our southern border. We have to get spending under control. In this omnibus bill, when we went through it, we found a lot of money that was just, we believe, wasteful spending that's unnecessary, money that is being, sent to all sorts of international organizations, money that's being sent overseas on programs that aren't working, they're not meeting their metrics. So all of that, I think, needs to be looked at. And I think one of the biggest things we need to do is really drive American energy production in this country. I'm all for clean energy, but we cannot just dismantle our traditional energy sources. We need to ramp up that production to drive down energy costs for American businesses and for families who are struggling right now, paying for food and paying for heat and hot water and all the other utilities.
Congressman, I suspect this is not the way you think of it, but listening to you, you can think about this as playing defense and playing offense. Defense, preventing some spending, for example, that otherwise might get done. You can do that. And offense being dealing affirmatively with some issues such as, for example, immigration and border security. That may well require bipartisanship, right? Because the Senate will still be controlled by Democrats. Do you see room for a bipartisan action on immigration? Because I think everyone agrees we got a big problem.
Mm-hmm. Yeah, look, it is defense and offense in many ways. As a member of the minority, we fought really hard to stop some of the radical election law changes they wanted to put in place, using taxpayer money to fund campaigns, for example. But, packing the Supreme Court, anti-police measures, we stopped those things by exposing it to the American people and getting them on our side. However, now in the majority, certainly offense, trying to get a lot of stuff done. Our priorities, one of my biggest priorities for New York City to keep us safe is to pass a measure that would require states to give judges discretion to set bail and hold dangerous criminals. That is one of the reasons why crime is so out of control in New York City, because they've been stripped that discretion by the state legislature. But yeah, on border security, I think, there's going to have to be some compromise, but we cannot compromise, right? If we don't start with the main issue, which is there is a insecure border right now. The border is just a free-for-all, and we have dangerous people also being mixed in. 1 million people that are gotaways, 100 people on the terrorist watch list that were caught at the southern border, all the drugs and the fentanyl, tens of thousands of criminals that have been previously deported, caught re-entering. Who's among the 1 million gotaways that have entered into our country? And as a New York City member in a post-9/11 world, that is what scares me the most. And we also have to take into account, because my mother's a Cuban refugee, we have to make sure we help those asylum seekers. But there are 70% of the individuals who do not have legitimate asylum claims. So that needs to be differentiated right now at the border. And individuals who don't have legitimate claims, they need to be turned away. and it's not fair to those who do have legitimate claims because they're getting caught up in the system and now waiting over a year just to get a court hearing, and that's wrong. So we got to stop what's clogging up the system to begin with.
Congresswoman, again, I hear from a lot of people there is a real issue with border security, no question about it. You said that's the main issue, but we also hear from a lot of business people and a lot of economists here at Bloomberg. There's also an issue with making sure we have enough workers, because there is another side to this, right? We need to make sure we have the right people in here who can do the work, because we actually have a shortage of workers in a lot of parts of the economy.
Yeah, and that's what our immigration system really should be based on. People who have family members here who can sponsor them, or employers here that can sponsor them. And we should be focused on that. But the system is so broken. But I think we should be focusing on the visas. We should be focusing on the legitimate asylum claims and having enough judges there at the border to differentiate the two. And we have to encourage people to be applying from the next safe country, not to be, coming to our border. That is, I think, one of the biggest messages the President of the United States should be sending. And then, of course, that border security component. But if you don't stem the flow, I think we really can't have a discussion about any of this. But I think those are the three components that we can and should be focused on in a bipartisan manner. And as a member of the Problem Solvers Caucus, I'm committed to having that discussion, but it needs to make sense, and it needs to be something that the American people will support.
In order to get there on your agenda, you're going to need a leader. And I know you're in favor of Kevin McCarthy, Congressman McCarthy, being the Speaker of the House. Will he be the Speaker of the House, and what will it take to get him there? Because it looks right now like it's iffy.
Well, I do believe he's going to be the Speaker. And you know what? Kevin has done an amazing job traveling all around the country, helping different candidates, recruiting a diverse slate of representatives who reflect America. And he does deserve to be the Speaker. He has a common sense, a practical approach. He's a fiscal conservative, but he understands also that we have to get things done, and we're going to have to work in a bipartisan manner to do that. But he's not going to sacrifice our Republican conservative principles to get there. He instead we're going to use our leverage. I think that at the end of the day, we're willing to negotiate, but we also need to hold the Democrats accountable when they're doing the wrong thing. And so I think he will be a great leader. I look forward to working with him. And I think that he will get there. I don't know if he'll take more than one vote, but right now it seems that there's only about a handful of holdouts, and who knows if that changes between now and Tuesday. He's incorporated, by the way, a lot of their suggestions on how he can operate better in the House.
Does he get there with only Republicans' votes, or does he need to pick up a handful of Democrats in order to get there?
I think he intends to get there with only Republican votes.
Fascinating. You've got a lot on your agenda. You've described a fair amount of it. I'm sure there's more as well. You've got the speakership to resolve. At the same time, there is this issue of George Santos that's come up. And I wonder, it was always a difficult thing you were going to have to get done as Republicans. How big a distraction is this for you at this point to actually even have to deal with it?
I think it is a distraction. I think it's very unfortunate. I'm certainly disheartened by what we're learning each and every day. At this point, there are a number of investigations. We'll see where they lead. I think he has a lot of explaining to do for his constituents. I think that is certainly a breach of trust. Not just for his constituents, but for colleagues. I think it's going to be difficult for him to move forward and continue in a way where he will have trust from both his constituents and his colleagues. And I think that's a major problem.
So I'm not familiar with the process, and so you know it better than I do. And I'm not sure there have been a lot of cases like this, but in general, whose responsibility is it? Is this left up to the prosecutors? You've got both state and federal prosecutors, evidently, that are looking into this. You've got the Republican caucus. You also have the Republican delegation, actually, from New York. Who has the lead in this and sort of dealing with this issue?
Well, I imagine it would be something that perhaps is going to be referred to the House Ethics Committee, and there'll be an investigation there, particularly if it relates to filing paperwork in which he may have made false statements. So I think there'll be an investigation there. And then, as you know, the Nassau County District Attorney has also launched a separate investigation. So right now, it seems to be a matter of trust between he and his constituents. Now, whether it turns into something else and something perhaps criminal, that's a different story, and that's what these investigations are seeking to find out.
Last one, Congresswoman, and that's these Trump tax returns. I haven't gone through them. I expect you haven't gone through them. I don't know what's in there. Who knows whether it's right, wrong, or different. But I wonder more broadly, are we opening up a Pandora's box here about releasing tax returns?
I certainly think that this is the Democrats on the Ways and Means Committee weaponizing their role against what is now a private citizen. This has always been an issue that is left up to the discretion of the candidate. He was very honest and said he wasn't releasing them, and people elected him anyway. But at the end of the day, if they want to require it by law, then they should do so in statute, not just targeting one individual. So I think that is where it becomes, a weaponization of the committee against a particular person who is a private citizen today. So if you're going to do it, you pass a law that requires everyone to release it, not just target one person.
Congressman, I can't thank you enough for being here. Happy holidays once again to you. That's Nicole Maliotakis, Republican of New York. Coming up, we're going to talk about deals with Bill Curtin of Hogan Lovells. And this is Bloomberg.
Go.
After hardly a full year of name, image, and likeness deals being a reality, UCLA quarterback Chase Griffin already has more than 20 deals with major brands, venture, and charitable groups, all while balancing graduating undergrad in just 2 years and fighting for playing time on the field.
Chase Griffin out of the gun. We are joined by UCLA quarterback Chase Griffin, not just UCLA quarterback, but name, image, likeness superstar. I am psyched for this one.
This kid could actually be the president of the United States someday.
When it comes to building generational wealth, it's not about the money that you make in college. I'm very excited that I made the amount of money that I made last year. I am even 10 times more excited that I know how to make that money.
The top names in business are on Bloomberg.
I think you have to assume that we have some bumpy times ahead, and you have to be a little bit more cautious with your financial resources, with your sizing and the footprint of the organization.
So what can you do near term? Test to make sure you see at the margin you can move things around, manage your expenses very carefully and invest in efficiency and effectiveness, but also continue to spend money where you have competitive advantage.
Nobody covers business like Bloomberg, your global business authority.
This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. Well, 2022 was a pretty rough year, I think it's fair to say, for a lot of equities. And right now, it looks like they're not having a very good day today either. Here to bring us up to speed is Abigail Doolittle. So, Abigail, where are we?
Well, David, you know, it has been an extremely rough year. And right now we have stocks whimpering right to the end. The S&P 500 down about 0.7%. That may not be the best sign for next year. We'll have to see. But the fact that the bulls can't put two big up days together, well, that tells you that the bears are stronger. That said, anemic strategic volume, 30% below the average. But to that year you're speaking about, a bear market for the S&P 500 down about 19 to 20%. The NASDAQ 100 down even more, down about 30%. Some of the other tech indexes down 40%. So a big sell-off after the huge out of the pandemic rally. But probably what's taken so many people off sides or off guard, David, the sell-off that we have seen in bonds. This as yields have simply shot higher as the Fed has done its historic hiking and is expected to continue to hike in 2023.
So, Abigail, there's a lot of doom and gloom out there about 2022. I'm not anticipating 2023 yet, but 2022. By the way, if you look at the Financial Times, you look at the Wall Street Journal, you look at the New York Times, all of them have a lead story right now saying, boy, this is a terrible year for stocks. Were there any bright spots?
Well, you know, David, I'm so glad that you're asking that, because over the course of this week, as I've been taking a look at some of the indexes, the Bloomberg terminal, of course, has so many great ways to break down the stock indexes and other markets. The thing that has stood out to me is the fact that we as the media have focused on the gloom and doom, but there's 175 stocks in the S&P 500 that are higher. 2 of them are a double, Occidental Petroleum and another energy stock. Energy overall up 56% after gaining about 50% last year. That's where a lot of investors have been hiding. But it's also the defense contractors, stocks like Northrop Grumman or Lockheed Martin up 35% or more. And then some of the staples, Kellogg and General Mills up more than 25%. Who knew? We've been so focused on what's been going wrong. You've had a lot of stocks that have been going the right way. So for a stock picker, there may be some managers out there who will really outperform once we start taking a look at those numbers in January.
And what about defensives? Is that someplace that people are running to?
Oh, absolutely. Well, utilities, there's only one sector higher on the year. That is energy, as I was just mentioning, up about 56%, with oil also gaining despite the fears around a recession, probably a little bit of the war in Ukraine, a piece of that, but and issues with Russia clearly in terms of supply and the like. But utilities down just 1%. So of course, it's funny, David, because typically utilities do well when yields are going down. Yields, as I was just speaking about, spiking on the year, that 10-year yield up about 2.5%, the 2-year yield up even more. But utilities typically do well when yields go down because they have dividends. But this year, folks want defense, so they're going into your utilities, you're going into your staples and healthcare because you get that dividend along with the stock performance. And then a couple of those staples that I was just mentioning, Procter & Gamble also in there, or Kellogg and General Mills. Not only do you have management of passing along high prices to the consumer, you also have those utilities. It's going to be interesting to see if that trend, the defensive sectors, lead in 2023.
It will be interesting. You'll be here to tell us all about it, I hope. Thank you so much to Abigail Doolittle for that report on the markets in 2022. And the markets in 2022 did not necessarily like mergers and acquisitions. 2021 was a record year. 2022, not so much. We welcome now somebody who's a true expert in mergers and acquisitions. He's Bill Curtin, head of mergers and acquisitions at Hogan Lovells. So welcome back. Great to have you here, Bill.
David, it's great to be back with you.
So go back in history just a little bit before we go forward. As I say, 2021 was a record year, shooting the lights out. 2022 struggled a bit.
You have it exactly right. 2022 was a dose of reality check after a frenetic 2021. 2021, keep in mind, was not like anything we'd ever seen, both in terms of aggregate transaction value and also the number of transactions that were accomplished in 21. The thing I like to remind people, David, though, is 2022, while a bit of a reality check, still exceeds in volume of transactions and aggregate transaction value the last 20 years other than 2021.
Oh, is that right? I didn't know that.
So even though we've come down dramatically in the second half of 2022, and we have, I mean, you can see all the slopes in the charts, as you mentioned, David, they came down quite a bit in the back end of 22, particularly in the technology sector. We still have a performance in M&A that augurs pretty well going forward.
That's interesting because technology also, as stock values, did not do very well in 2022. Do those often track one another?
They do, because it's all about executive suite confidence. So it's very psychological, M&A. Of course, cost of capital is important. Of course, the regulatory dynamic is important as well, and sort of the general economic conditions that we face. But at the end of the day, executives in the C-suite are looking to their left and they're looking to their right. And they're thinking about what their competitors are doing. They're conscious of what their stakeholders expect them to be accomplishing. And they're very mindful of where they want their companies to be going. So there's a lot of subjective, soft elements to what drives M&A.
You mentioned cost of capital. I was going to ask about the Fed and the interest rates, which have to be a factor, obviously. How much have they been a factor in 2022, and how does it carry over into 2023?
Very significantly. What the Fed has done in 2022 really put yellow lights and brakes on all the momentum that we had coming out of 2021. Think about what happened to us in the United States. We're a country of extremes, and we generate 50% of global M&A around the world, right? So we moved our way through the pandemic, and it was really tough for us at the front end. It was extreme, right? But then we were quite nimble. In a sense, the pandemic to me was an M&A event, right? It was non-organic. It wasn't anticipated, and it certainly wasn't a straight line. And we moved our way through, and we moved through with so much heat and so much intensity in the marketplace that, of course, it drove us into an inflationary state and potentially recessive economies. The Fed had to react. The question was, did they overreact? Did they react quickly enough? How did they modulate the reactions? And what do we expect for 23 going forward? I think there will be a bit of a drag, David, on the front half of 23 because of the Fed's interventions, needed as they were. And I think on the back half of 23, you're going to start to see M&A recover and lift even more.
So uncertainty is a big enemy of mergers and acquisitions, as I understand it. At the same time, as you look at prospects for mergers and acquisitions, to what extent is the financing even available, even at a higher price?
Yeah, the cost of capital has increased, no question about it. On the other side, what's very interesting is the valuations and the cost of actually acquiring the targets has decreased, right? So I love the way Abigail was describing the capital markets in your last segment, which is, yeah, tougher sledding right now. No Santa Claus rally, right? Tougher sledding, but opportunistic, right? Looking forward. And that's what I see for M&A. So private equity now accounts for almost 1/3 of the transactions that occur in the marketplace globally now. And they are shrewd and astute, and they are looking for their opportunities as valuations decrease going forward to snatch up some really wonderful assets in the marketplace.
And do they have a lot of money to deploy, as they say, dry powder?
Tremendous amounts of dry powder stockpiled from the excesses of the capital markets and the liquidity experiences they've had. Remember, 2021 generated for them tremendous returns in investment in private equity. Those sponsors are lined up, and they're watching life sciences, healthcare, they're watching technology, they're watching the energy and natural resources spaces. And I expect in the back half of 23, you're going to see some really significant and shrewd deal-making by the sponsor side of the community. And I think the strategics will do the same as well. If you look at the automakers, for example, if you look at the Mustang, the Mach-E technology, right, which is an electric vehicle now, right? And you think about what Ford's looking at, right? 60% of the purchases of Mach-E Mustang technology of cars were from folks who owned other brands of vehicles. So if you're Jim Farley and you look at that, you're thinking, wow, what an opportunity I have to move people who are loyal to another brand over to my brand because my technology is moving forward. And that technology advance depends on M&A.
Are you having clients call you up and say, look, I've been looking at that company for a long time, couldn't afford it, now I can because the price is lower?
Absolutely, and they're saying, let's move quickly because there's less of an auction mentality in the marketplace. 2021, the valuations were so high, David, and the auctions were so competitive. Now things have abated, and as I said, we've come back to a bit of reality. And so buyers have an opportunity to engage in bilateral transactions. They don't have to compete against 11 other bidders, and they have lower valuations. Yes, the cost of capital is higher, but they can quantify that into their purchase price and still execute a very successful transaction.
So let me put you on the spot and talk politics with you as a lawyer, okay? In this limited sense, we now have a split Congress.
Yes.
We've got Republicans in the majority in the House, Democrats in the Senate. Does that help the C-suite? Because that means that Congress is probably going to be less active. We were talking about certainty being the most important thing.
I actually see it exactly that same way. I don't believe that so-called gridlock or the bipartisan circumstances that we face are negatives for M&A. Predictability is the key. We got through those 2022 midterms, and we got through them with some decent clarity, right? We didn't have a lot of election contests out of that process, and we know where we're going forward now. We have the Inflation Reduction Act. We have Biden's infrastructure plan. All of that is settling now, David, and that puts C-suite leaders in a position of understanding predictability as long as they can figure out the antitrust.
Well, I was just going to say, take the other side of the trade, because when you talk about predictability, I'm not sure we have that in antitrust right now because the Biden administration says they want to change all the rules.
Watch the first quarter of 2023, and I'd love to come back and talk to you about it again, David, because watch the first quarter. The FTC and the DOJ have already announced that they are going to put in place new measures about what they deem to be unfair competition. This is beyond the Sherman Act. This is beyond the Clayton Act. This is where they could see, for example, private equity firms serially acquiring businesses that are underneath the thresholds for reporting requirements, but the FTC and the DOJ think that they're anti-competitive in their accumulations.
So this is a great point. You put together that 1/3 of the M&A comes out of private equity with the fact that the administration has been very explicit. We think there's shenanigans going on, my word, not theirs, in private equity. You could really put a freeze on a lot of M&A deals.
Think about this. In Europe, they actually have a name for this. The antitrust regulators in Europe call them killer transactions. Killer transactions are technology companies that come into Europe and buy up smaller companies before those companies can become meaningful competitors and threats. So you look at the European authorities now, and they're looking at Microsoft bundling the Teams technology with the Outlook technology and not liking that very much, right? And so they're watching these big, powerful tech companies that drive a lot of M&A and a lot of capital markets rewards and looking at them quite suspiciously, David.
I'm going to try to sneak in one last question. As you look at your M&A practice, is Europe, the European regulators, or the American regulators when it comes to competition and antitrust the bigger problem for you?
There's a term now called the Brussels effect.
Really?
There's a term that's emerged in the practice of M&A called the Brussels effect, which is watching what comes out of Brussels and the European Union and seeing the impact it has on the FTC and the DOJ. And I do believe you've put your finger on a very important point. We cannot just live in the narrow confines of the U.S. regulators. We have to watch what the Europeans do and how they impact the way of thought here in the United States.
It's fascinating as an old antitrust lawyer to think of us following Europe instead of the other way around, because for many years it was the other way around.
You're quite right.
It's fascinating. Thank you so much. Really great to have you with this Bill Curtin of Hogan Lovells. And now to keep you up to date with news from all around the world, we turn to Lisa Mateo here with the first word.
Thank you, David. Vladimir Putin and Xi Jinping hailed deepening ties between Russia and China in a video conference today. Putin says the relations are the best in history. Meanwhile, Xi said China is ready to expand the relationship. Still, there are signs that Beijing is impatient over the political and economic impact of Russia's struggling invasion of Ukraine. Some tense moments over the South China Sea. A Chinese fighter jet flew within 20 feet of a U.S. Air Force reconnaissance plane. The U.S. military says American planes had to take evasive maneuvers to avoid a collision. China asserts rights to more than 80% of the South China Sea. In the UK, a new poll shows the size of the challenge facing Prime Minister Rishi Sunak and his Conservative Party. The survey conducted by People Polling shows that Labour has a 26-point lead over the Conservatives. The next election is expected to be held in 2024. And after a week-long meltdown, Southwest Airlines is returning to a normal schedule today. Thousands of Southwest passengers were stranded across the U.S. because of cancellations caused by winter storms and overwhelmed technology. The carrier scrapped more than 13,000 flights in the last week. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg. David.
Thank you so much, Lisa. Well, it may be the eve of New Year's Eve, but we have a lot of politics to talk about today. We have, of course, those Trump tax returns that have been disclosed. We're going to figure out whether we learned anything out of that. And by the way, will we get more tax returns from more national leaders as a result of this? At the same time, we've got a debate now about if President Biden actually does run for re-election, where is his headquarters going to be? Some of the young would-be staffers don't particularly want to go to Wilmington, Delaware for some reason, because they say there's not much of a nightlife. And of course, we have to talk about Samuel Bankman-Fried and his visits to the White House leading up to the bankruptcy of his company. So we're going to talk about all of that with Rick Davis from Stone Court Capital and Jeannie Chianzano of Iona University. They are Bloomberg political contributors. And this is Balance of Power on Bloomberg Television and on radio.
We were thinking big from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
A lot of these areas still have very, very good valuations.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
Talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight, with replays all weekend on Bloomberg Television and Radio. When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. Well, this holiday season, we've had the great luxury of having our political contributors, Jeannie Shanzano of Iona University and Rick Davis of Stone Capital on every single day. I couldn't be happier than having that happen. In the meantime, we've got some news today. Rick, we've got now former President Trump's tax returns out. Did we learn anything that we didn't kind of know? He doesn't pay very many taxes, and he's pretty aggressive in taking his deductions?
Yeah, we knew. And look, he disclosed all that when he was running for president. He's like, "You're a sucker if you pay your taxes," and so he's no sucker. He's done everything he could to avoid taxation, and we learned a lot back in 2018 when the New York Times published what they had in a leaked tax report that they did. And so we've actually been learning a lot just in more recent years on the tax returns that the committee, the Ways and Means Committee of the House have released. But what I think is really the bombshell is, why didn't the IRS, do their annual audit of Donald Trump? I mean, it's actually nothing to do with the tax returns, but in the course of this investigation, Richie Neal, the chairman of the Ways and Means Committee, asked for those audits, and it was like, oh, what audits? So I think the IRS out of this is the big loser, even more so than Donald Trump.
Jeannie, what do you think about that? I'm going to pick out two numbers here that I saw from the reporting on this. Number one, he had more than 400 flow-through entities going into his 1040. So there's like 400 entities out there you had to audit. And number two, the IRS assigned all of one auditor to it.
Yeah, that's right. And, I think it tells sort of an old story in politics and, quite frankly, in government, which is that sometimes it's what's legal which is most stunning. And, you see this a lot. You see these pass-through entities, and they are very complicated tax returns. The release today was about 7,000 pages of raw data. The Ways and Means Committee had released 2 reports prior to this. Then they redacted personal information, have dumped the 6,000 to 7,000 pages, so all the Bloomberg reporters can quell through those. And there's a lot of big questions here. One question I think that's important for all Americans to remember is Donald Trump was the first president who had a very strong background and life in business and a lot of business entanglements around the world. This was a big issue when he was elected. And of course, now we have questions about, did he get influence from foreign operatives, people overseas in China, Saudi Arabia, Russia? That's going to be one of the questions. Of course, he had a lot of deductions, these pass-through entities. But again, people are saying it doesn't look like maybe what he did was illegal, at least at this point necessarily, although it may turn out that way. But it's more stunning what is legal. The idea that somebody as wealthy as he portended to be has paid in, 3 of those years, just $750 or less. People making minimum wage pay more than that. And that is stunning for the fact that it is legal. And then, of course, what Rick mentioned about the IRS's dereliction of duty in terms of performing its regular audit. Congress needs to codify that into law so they can't circumvent that next time around.
So, Rick, there's been untold ink spill boiled, or maybe it's pixels flashing on screens is what we talk about now, over this subject. Does it all amount to more than a hill of beans, if I can put it that way? I mean, we spent a year and a half looking at January 6th. We got a report out of Congress. We're probably going to have a lot more investigations coming up the new year with the Republicans in the House. But do these amount to anything, or is it just politics?
Well, I think actually what it amounts to is politics. I mean, voters will be influenced by what they learn about the fact that Donald Trump has not been, contributing much to the federal treasury at a time when he's, as his own definition, has become immensely wealthy. And so that's going to have a negative impact. I mean, we sometimes forget that he's actually an announced candidate for president. In fact, he's the only announced candidate for president for 2024. And so I think this will have a negative impact. I am sure investigators will be poring over these returns for the next couple of years, looking for a way to go after him. But I think this is the key thing. He's actually, for the first time, had his returns released in a formal way. And by the way, all the Republicans that are moaning about this, they should have been moaning about this back when Joe Biden released his tax returns at the beginning of the campaign in 2020, and Donald Trump did. Oh, and maybe Donald Trump should have released those returns back in 2015 when he was first running for president, when he said he was going to as soon as that audit was over. None of this would be an issue today if he'd have done either one of those things.
Yeah, which had been done by every president since Richard Nixon. Of course, he chose not to. But again, he is the first president who had such an extensive background in business, which may help explain in part, there's also the personal aspect. We all know that Donald Trump famously wanted to be portrayed as being incredibly wealthy and a great businessman. That was part of his brand when he ran. I'll run the presidency the way I ran my businesses. Well, if the tax returns show that his business entities weren't doing well, as the New York Times reported in their, bombshell piece a couple of years ago, then that gives lie to this brand. So there's a whole lot of complicated politics involved in this for somebody who is running for president again. But the reality is the American public has a right to know, if you choose to run for president and choose to serve, that you are not beholden to domestic or foreign influence, that you aren't under financial difficulty so that you can be influenced in a way that negatively impacts public policy and the way you run the government. That's something we all deserve, and transparency is a huge part of that.
Well, let's talk about transparency. I'm going to take a detour here because we have a viewer actually writing in with what this is my characterization. Is this the pot calling the kettle black? Because it may be that we haven't had that many people run for president with very sophisticated investments. We've got a fair number of people who sit in the Senate and the Congress who do, and there's a lot of questions about the trading that they're doing, perhaps based on information they're getting. Are we ever going to get reform of that, Rick Davis?
Yeah, I think there's some motivation to do that. We saw a lot of activity in the House of Representatives this year. It'll be interesting to see whether Republicans pursue that if and when they take over. But they do a lot of disclosure. If you're a member of the Senate and the House, you're disclosing your holdings, you're disclosing your trades. You may do it after the fact, and that's how we've learned about some of these, what we would apparently be called violations in the past, by the normal disclosure of activity. If they choose not to disclose, they're violating Senate and House ethics rules, which are punishable through the ethics committee. So they're self-policing, but at the same time, there are requirements. So whether or not that goes out, results in a ban on trading, I don't know. I mean, it's going to be a tough slog to get anything like that through the Senate.
Jeannie, as long as we're talking about money in Washington, let's talk about Samuel Bankman-Fried, who made a lot of donations. Democrat, and it appears Republican as well, although we have a lot more information on the Democrat side. And now we have information that he had several meetings with fairly senior staffers at the White House.
Yeah, he did. He and his brother, Gabriel, apparently had 4 to 5 meetings in the White House with top senior aides to the president in this year alone. I think the reporting was on Bloomberg between March and the fall of this year. And, of course, Sam Bankman-Fried was one of President Biden's most largest donors in the 2020 campaign. I think the number is about $5 million or more. And he famously gave to Democrats, and we have that that recorded at about 40 million. And he said himself, if he can be believed, which is a big if, that he gave equal amounts in dark money to Republicans, which would make it about $80 million. And you want to talk about the buying of influence to get a voice in Washington. Well, we know he gave, for instance, to the heads of the Agricultural Committee in the Senate who are charged with regulating crypto. And this is what is really, really got to be frustrating for the American public, is that money is out of control in our politics, and it does buy influence and access. He spent an awful lot of time in Washington. We didn't get crypto regulation out of it, but probably only because he was arrested before we could. And that's something that I think both Democrats and Republicans are going to have to answer for.
So, Rick, as far as I can tell, this is not about Arizona, but it does lead me back to the late, great John McCain, with whom you worked, Senator from Arizona, because he was really bullish on some sort of campaign finance reform.
That's right, and this is a bombshell when it comes to money in politics. I mean, as Jeannie reports, almost $100 million went out in 1 or 2 election cycles from these guys, and they did it for one reason and one reason only: to save their own skin. They were running a Ponzi scheme down there in the Bahamas, and it is a scandal of epic proportion, and usually these kinds of scandals start the conversation about how we need to reform our campaign finance processes. We're going to see a lot of prosecution around this. We're going to see a lot of embarrassed people who took money, and the White House should immediately go out and launch their own campaign finance proposal, considering they're right at the heart of this scandal.
Okay, you guys are the political experts. I'm actually the lawyer. I still have a bar card. I'm just going to say alleged Ponzi scheme. I don't think we've proven that yet. There's a lot of investigation left to be done. Thank you so much to our political contributors, Rick Davis and Jeannie Shan Zaino. Great to have you here all week long. Check out the Balance of Power newsletter on the terminal, also online. Coming up, Balance of Power continues. In our second hour, we're going to talk with Ishwar Prasad of Cornell about what was clearly a rough year for crypto and what that could mean for digital currencies more broadly. And this is Balance of Power on Bloomberg Television and Radio.
I'm going to name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It is the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
Of the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Most of us don't spend much time thinking about the grid, the dizzyingly huge system of cables, transformers, and outlets that reliably powers our lives. It's an easily ignored, change-resistant part of the modern world, and that's the way we like it. But as we move towards less planet-melting ways of producing electricity, the grid is going to have to evolve too.
We are seeing so many countries and governments announcing high targets when it comes to decarbonization and being climate neutral. But this is just one side of the coin. It's not enough to simply generate green energy. We also need to make sure that this is transmitted and distributed to the end consumers.
The grid of today just isn't equipped for renewables. So a new kind of grid is starting to take shape. The supergrid.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
From the world of politics to the world of business, this is Balance of Power with David Weston.
From Bloomberg World Headquarters in New York to our television and radio audiences worldwide, welcome to the second hour of Balance of Power. Well, one of the asset classes that we'll be happy to see 2022 in the rearview mirror will be cryptocurrencies. They had a tough time of it right pretty much through the year. To take us up to bring us up to speed on where they are, welcome now Hannah Miller, who covers crypto for Bloomberg. Hannah, thanks so much for being here. We're focused on Samuel Bankman-Fried and FTX, but crypto was not doing that well even before that happened. Is that right?
Yeah, it's important to remember that FTX was not the only setback for crypto this year, that maybe it was the biggest one, but there were a series of other events that made 2022 quite rough for the digital asset industry.
So what are the origins of that as far as you can tell from your reporting?
Yeah, so I think a big milestone was the collapse of the Terra USD stablecoin. It was not so stable, turns out, and that really set off a cascade of events within the industry. So we saw the crypto hedge fund 3 Arrows Capital go bankrupt, crypto lender Celsius freeze withdrawals and then file for bankruptcy, and we just saw this series of events stemming from that contagion. And, you know, I think everything's kind of led up to FTX. You know, the collapse of FTX is certainly one of the biggest stories in finance and, of course, in crypto.
So, Hannah, one thing that has me curious, at least, is would regulation have made a difference? Because we've heard from various people in the crypto area, including we heard from Samuel Bankman-Fried, that they really wanted regulation. I'm not sure whether regulation would have made a difference, whether it's FTX or some of the others that you just described.
Yeah, so I think in some cases, you know, companies and founders have been able to take advantage of a regulatory gap. You know, the crypto has been referred to as the Wild West by SEC Chair Gary Gensler, and that kind of created these conditions where people could do, you know, a lot of things that you can't do in traditional finance, and that led to customers, you know, losing money and, you know, not being properly protected.
So what are the prospects for regulation in the new year and in the new Congress, I really should say?
Yeah, I think we can definitely expect regulators to step up. The SEC has already indicated that their patience is wearing thin with companies, that they want them to register with the SEC and that they consider most cryptocurrencies to be securities. So I think we can expect, you know, more regulation and clearer guidelines for the digital asset industry.
Anna, thanks so much for being with us. That is Hannah Miller. She covers cryptocurrency for Bloomberg News. And now we turn to an expert in digital currencies, including cryptocurrencies. He's Ishwar Prasad, Cornell Professor of Trade Policy and New Century Chair in Economics at the Brookings Institution. Dr. Prasad is author, most recently, of The Future of Money, How the Digital Revolution is Transforming Currencies and Finance. So, Ishwar, first of all, Happy New Year. Great to have you with us. Give us your perspective on how big a hit cryptocurrencies took this year.
So it's worth thinking about the questions about crypto as we headed into 2022, David. One was, is crypto a durable asset class? Second, could crypto perhaps even serve as a hedge against inflation? And third, would crypto technology in the form of decentralized finance actually help to democratize finance by giving more people easy access to products and services and serve as a challenge to traditional financial institutions? On the first, the answer seems to be apparently not. Crypto seems to be a very volatile asset class. It seems to be buffeted by the same macroeconomic factors as other risky assets, but is much riskier. And certainly there is no evidence as of now that Bitcoin or other decentralized cryptocurrencies can serve as an effective hedge against inflation. And then there is a question whether the technology can really help to democratize finance by creating new financial products and services, giving new players easy entry into the financial system, allowing them to compete with traditional financial institutions. That promise hasn't been realized so far. What we've seen so far is a lot of financial engineering, a lot of people who are not really able to take on those risks, taking on a lot of risks, and basically a lot of retail investors getting hurt. And the one big takeaway really is that decentralized finance, especially Bitcoin and other decentralized cryptocurrencies, are not as decentralized as we had thought them to be. So for instance, there are centralized exchanges like FTX, which has just collapsed, or Binance, the largest cryptocurrency exchange, where there are lots of vulnerabilities lurking. So if you cannot trade or custody crypto assets in a durable way, in a secure way, it doesn't seem to me that this is going to be really a durable asset class for the future.
So, Ishwar, roll that up on one question. What's the use case at this point for cryptocurrency? Because as I just listened to you, I don't hear it at all.
So the idea here is that you are going to have a technology, at least the blockchain technology that was bequeathed to us by Bitcoin, that will allow a lot of products and services to be created without needing financial institutions that have brick and mortar operations. And that would give essentially anybody, even low-income, low-net worth individuals, easy access perhaps to bespoke financial products and services. But like I said, we're not seeing that so far. And at the moment, what we're seeing is just a lot of financial engineering. So you're right, David, that at the moment, the use case for blockchain technology and for decentralized cryptocurrencies remains a bit of a mirage that has not quite been realized yet.
Well, and I studied your book, as you know, Ishwar. I keep it on my shelf to go back and to refer to it. And one question I have is the difference between a digital payment system on the one hand, on the other hand, a cryptocurrency, a true digital currency. Can't you achieve an awful lot of what you want with the digital payment system? And a lot of existing companies are doing that, including in some of the less banked areas of the world.
That's exactly right, David. I mean, electronic payments are becoming pervasive in much of the rest of the world outside the U.S. In the US, we still use currency a fair bit, but in many low-income economies, middle-income economies, such as China and India, the use of cash is plunging to very low levels. Now, it turns out that one can also use those very same technologies that can underpin electronic payments to also serve as a portal for basic banking products and services. In Kenya, for instance, a mobile-based payment technology has now served as a portal for very basic products for managing credit, risk, insurance, and so on. So I think there are certainly other ways of accomplishing many of these objectives without needing cryptocurrency-based technology. And even in the US, where the Federal Reserve is rolling out FedNow, which is a suite of improved payment options both at the retail and wholesale levels, certainly the use case for cryptocurrencies is going to be significantly undercut by that.
So, Ishwar, something you and I have talked about in the past, I'd love an update on, is what I would call the international competition in this. Let's talk about China specifically. I understand they're trying to develop a central bank digital currency themselves. I saw they just announced they're just opening up an exchange for, we would call them NFTs. They have a different name for them, but they're going to have that. It's an exchange. They're not creating themselves, but they're facilitating exchange of it. Where is China on digital currencies?
So China has banned decentralized cryptocurrencies and cryptocurrencies, private cryptocurrencies more broadly, although they do seem to be promoting blockchain technology as a way to promote financial innovation. So there is some aspect of the cryptocurrency related technologies that they still seem to be relatively favorably disposed towards. Now, China, like many other countries, is developing its own central bank digital currency, or a digital version of its central bank currency, because hardly anybody in China uses physical currency, that is cash, for retail payments anymore. And like many other countries, China seems to view this as an alternative payment option, one that does not necessarily squeeze out private payment providers, but provides a central bank-based option for retail consumers as well as businesses to be able to use. And I think there is some traction to be got, and many other countries around the world, of course, are moving forward with central bank digital currencies as well. So these will even more significantly undercut the case for cryptocurrencies as payment mechanisms. Even stable coins which are supposed to provide stable value, thereby getting around one of the problems with other cryptocurrencies which have unstable value. Even for stable coins, the case is going to be far from obvious if we do have CBDCs which provide easy forms of digital payments.
Ishwar, stay in China, if you would, and go more broadly to the economy. Obviously, China had a rather rough year as well with the COVID zero policy that they're coming off of now. They've got an uptick in infections. At the same time, there are underlying factors in their economy that may be deterring some of the growth that we have seen in the past. Can you tease out those two? How much of their problem right now is because of COVID that they'll get over, presumably, and how much of it is more fundamental?
The zero COVID policy was very disruptive, David, and in particular, it had one negative effect, not just in terms of short-term growth, but also in terms of long-term growth, because it restrained private consumption, and it had a particularly difficult hit on the services sector. And this sets back the growth rebalancing effort that the government has been trying to put in place, shifting towards a more consumption-led growth model, as well as an economy where the services sector is more dominant than the manufacturing sector. In the short run, I think the elimination of the zero COVID strategy is perhaps going to exacerbate these disruptive effects because of the fact that the government is simply not prepared for the surge in cases and possibly the deaths that will follow from the surge in cases. The healthcare system is not well equipped. But I think in the longer term, it was clear that this was an untenable strategy. Now, the question is whether this is going to revive the confidence both of the domestic sector, but also of international investors, because one charitable explanation of the reversal of the zero COVID policy is that the government is willing to be flexible. But a less charitable explanation is that the government sticks to its very rigid policies until it becomes clear that they are so untenable that there are people out on the streets protesting. And that is going to be really important, because unless the government can restore household and business confidence, it's going to be difficult to get consumption or private investment going. And that's going to be critical for longer-term growth in China.
I'm so glad you raised that point, because one question I hear being raised right now is the experience with COVID in China actually going to, over the longer term, change the risk tolerance of consumers and investors in China?
Right now, I think confidence is the key issue. There is a sense that the government, once it puts policies into place, is not willing to show much flexibility when circumstances on the ground change. And I think there is also the sense that this whiplash of policies creates additional uncertainty for investors, indeed for foreign tourists, foreign people going to China, having to go in and out of China. So there is going to be, I think, over the long run, less reliance on running supply chains through China, which is certainly going to affect China's role in the world economy. China still remains the second largest economy in the world, and what happens in China is going to matter to the rest of the world. But most foreign corporations, I think, are going to take a serious, hard look at whether they're willing to make their supply chains vulnerable if they continue running them through China.
Ishwar, really great to have you with us. Thank you so much for your time. That's Ishwar Prasad. He's Cornell Professor of Trade Policy and Economics. And now to keep you up to date with news from all around the world, we turn to Lisa Mateo here with the first word.
Thank you, David. In the Bahamas, authorities now say they seized $3.5 billion worth of digital assets at FTX shortly after the crypto exchange filed for bankruptcy protection. The Bahamas Securities Commission cited a risk of, quote, imminent dissipation of the assets. Now, that was based on information provided by founder Sam Bankman-Fried. Tesla is expected to announce record quarter deliveries in the next month. That may not be enough to satisfy investors as the electric vehicle leader faces concerns about softening demand. To clear inventory, Tesla offered a rare $7,500 discount to U.S. customers who took delivery of a new Model 3 or Model Y. The Inflation Reduction Act will restore up to that same amount in federal tax credits for certain EVs starting January 1st. The U.S. may give Ukraine's ground-fighting capabilities a boost. Bloomberg's learned the Biden administration may send Bradley fighting vehicles to Ukraine as part of another military support package. The Bradley is used to transport troops, but it's also armed with missiles and a 25-millimeter gun. And in Myanmar, Bloomberg's learned that the deposed leader Aung San Suu Kyi has been sentenced to 7 more years in prison after being convicted of corruption. It was the final round of verdicts against her since the military ousted her democratically elected government in a 2021 coup. Suu Kyi's total prison term is now 33 years. David.
Thank you so much, Lisa. Coming up, we're talking about the triple-demic with Dr. Asha Shah of Stanford Health. That's coming up next on Bloomberg Balance of Power on Bloomberg Television and on radio.
Bloomberg's covering all things crypto, the people, the transactions, and the technology. Bloomberg Crypto, only on Bloomberg TV and Radio.
This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. Well, we're in the middle of what they call a triple-demic here in the United States of America. We have COVID still around. We have the regular flu season. Then we also had some RSV hitting particularly children. To bring us up to speed on where we are in fighting these three diseases, welcome now Dr. Asha Shah, Director of Infectious Diseases at Stanford Health. So, Dr. Shah, always love having you on to explain this to us. First of all, tell us what you're seeing at Stanford.
So we have been seeing, an increase in all of these three respiratory viruses circulating over the past couple of months. In fact, the good news is that RSV seems to be leveling off, at least here locally, especially in children. But we are seeing a tremendous amount of flu circulating in the community as well as COVID-19.
And do we have a sense with, for example, the flu, how effective the inoculations have been? Because we were encouraged to all get vaccinated against the flu this year. A lot of us did. Do we have a sense whether the vaccine is not working as well or people just didn't get the vaccine?
So preliminary data shows that the vaccine actually matches up quite well so far to the strains that are circulating. Right now, what we're predominantly seeing is influenza A. But I agree that vaccine uptake, I think, has been less this season. I think there's a lot of vaccine hesitancy out there, and we are still encouraging everyone to get vaccinated for both flu and for COVID because it really works to prevent severe disease and hospitalization.
Well, and what about the vaccinations for COVID? What do we know about that? Because my sense is a fair number of people got the initial vaccine and maybe got one booster, but we're up to even 2 and 3 boosters now. They're people getting tired of these repetitive boosters.
Yeah, unfortunately, as each new booster comes out and new recommendations come out, I think some of these things get a little bit more confusing. But the bottom line is now that there is only one booster available. It came out in September. It's changed from the original formulation of the COVID shot in that it covers the Omicron variants that are circulating in the community. So it is recommended to get that updated booster to be up to date and to protect folks from getting severely ill from the COVID strains that are circulating right now.
One of the things that we've seen some evidence of is shortage of some medications. I mean, internationally, antibiotics, as I understand it, are short. We also have some flu medications that are short, and maybe even some over-the-counter.
Correct. So we have been hearing reports of local areas that have shortages of Tamiflu, which is the antiviral medication that is used to treat influenza. However, there's not, nationally a shortage. What we do recommend for physicians and practitioners is to use those antiviral medications and reserve them for individuals who are at risk for severe disease from influenza. So those that have other medical conditions, lung conditions, heart conditions. We also give Tamiflu to everyone that's hospitalized with influenza as well. There has been a shortage of amoxicillin, which is a common antibiotic used, especially in the pediatric population, again, because of the increase in respiratory viruses that we've been seeing in children, and then those children being prone to getting bacterial infections that we would use antibiotics for. So we're back to basically seeing people get sick with viruses, and this is what we were experiencing before COVID. Now we've dropped all of those mitigation measures, and so we're seeing an uptick in all of these things again.
So we're about 3 years into this pandemic now. Has it changed the way you do what you do at Stanford? Have you changed procedures? Have you changed the way you treat patients with respiratory infections?
So we've been treating patients with other respiratory infections for, even pre-pandemic. So we have not changed the way we, test them, the way we diagnose them, the way we isolate them, the type of PPE, the personal protective equipment we wear to see those patients. Influenza treatment and management also has not changed. And COVID treatment for inpatients hasn't changed either. I think now there's just more of a heightened sense of awareness about respiratory viruses in general because of what we've experienced with COVID. And we're tracking, rates and incidents and cases and hospitalizations much more closely now than what we did pre-pandemic.
Is there a heightened awareness, in your impression at least, among patients or would-be patients in this sense? Are people more inclined to go to the hospital earlier because they're concerned about this, or even the reverse than they were before the pandemic?
Well, I think now, never before has there been so much conversation about RSV, for example. And when we experienced this RSV surge a couple of months ago, it was kind of interesting for infectious disease doctors to see this because we've always seen RSV in children. There's always been a bump in cases in the wintertime. And this time it was nice to see that it was getting a little bit more attention. In terms of COVID-19, what's nice to know now is that the disease has become less severe. And so a lot of the COVID-19 that we're seeing is in the community, and patients are calling their primary care physicians. There's less of a need to present to an emergency room for care because many times, folks just get better on their own with just some rest and hydration and, good old-fashioned kind of supportive care.
Dr. Shah, you talk about people in the community with their primary care physicians. One of the things I think that we learned from this experience, those of us who are not professionals the way you are, is how many people don't even have a primary care physician. We have an issue with public health across the country when we try to respond to whatever the next pandemic is. Have we made progress?
It's a good question. I think there's been progress in certain areas, and definitely we have a lot of opportunities for improvement in terms of creating more access to healthcare. There are lots of sites for, free COVID testing. Vaccines, of course, have been free up until now. A lot of the therapeutics can be obtained for free, but that will soon change, next year. And that is concerning to us in the public health field, is that it's going to widen the disparities in terms of patients being able to access all of these tools that they need to stay safe.
One of the things that's been in the news the last couple of days is the United States now imposing, as I understand, a requirement that people coming in from China get tested before they get on the plane. Why is that, as far as you know, and what effect will that have?
Well, as we know, the COVID test is only good the day of the test. And so my understanding is that it's an effort to control, in a way, the global spread of COVID-19. That being said, China is not the only country where COVID is spreading. COVID is spreading worldwide. It's a global pandemic, and perhaps hopefully is endemic by now. And so, I think that's an effort to try to identify folks early on who may be, COVID positive and preventing them from coming in and spreading COVID more. That being said, COVID is going to be with us forever. It's not going to go away, right? And this is just becoming one of the circulating viruses that we're seeing along with everything else. And in fact, may become one of the more milder viruses compared to influenza and RSV, especially in children.
And finally, I'm mindful of the fact we're about to have New Year's Eve celebrations. What should we do? I mean, I don't know what you're doing. I won't ask you what you're doing. But if we're going to be with a lot of other people, should we be wearing masks, for example?
So I think it's about everyone's individual perception of their risk. So if you're someone that has a lot of medical conditions, if you're someone that's immunocompromised, probably best to, avoid crowded places or wear a mask. Make sure you're in areas that are very well ventilated if it's crowded. But for others, it's just a matter of using kind of the basics of infection prevention. Stay home if you're sick. Wash your hands, get tested if you have symptoms, and if you're positive for flu or COVID or anything else, sit this one out so that you're not infecting other people. I don't think we're in a stage anymore that everyone needs to stay at home and not spend time with their loved ones and their families and friends. But it's a matter of accepting the risk and understanding what that risk is and having a plan. If you do, in fact, get sick after such a celebration, knowing that you have access to testing or access to medications, if that's something that you would be, qualified for.
As you treat patients up at Stanford, do you have an impression that going back to school has exacerbated the situation? Is there any doubt that the kids should be back in school with one another?
I think the kids being back in school is the best thing for the kids. There is a tremendous mental health impact on all of these children from the pandemic. We're staying home, distance learning. So being in the classroom, in my opinion, is the safest place for kids to be. If they get sick with various viruses, stomach bugs, in the long run, in fact, that actually may be good for them because it's building up their immune systems when they haven't been exposed for the past 2 years. So I think school is the best place for them to be.
That's going to be reassuring to a lot of parents. Thank you so much. Always great to have you with us. It's Dr. Asha Shah, Director of Infectious Diseases at Stanford Health. Still ahead, Michael Arrighetti of Ares Management on the rapid growth of private credit and where it could lead in the new year. That's coming up next on Balance of Power on Bloomberg Television and on Bloomberg Radio.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one. And through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. We want to get a last check of the year on markets, at least for Balance of Power. For that, we turn to Abigail Doolittle. How are we doing?
Well, we're not doing so well. We're at par for the course for this year. Right now, we're near session lows for the S&P 500, down 1.1%. The tech-heavy NASDAQ down more, 1.2%. This, of course, has to do with bond yields being a bit higher here on the session, not wildly so. You know, the volume, though, not surprisingly, is off, 30% below the average. So a down year, a bear market year, that S&P 500 down 20% on the year or thereabouts, ending that way.
So talk about the bond yield. I mean, it's up this year, obviously, from where it started the year. At
It's
the same
incredible.
Time, but it's incredible. But it's all the way up to 3.8. If you look historically, that's not an astronomical number.
Well, great point. And also in that nuance, so at some point earlier this year, we were, sub 1%. So a massive, 2.5%, 2.7% move higher. But not so long ago, we were above 4%.
Yeah.
We're backing down. It's going to be interesting to see. There's probably lots of reasons to think we go back above 4%, but maybe investors have digested that level. And to your point, historically, it's still very, very low. So that's probably what the Federal Reserve is aiming for.
It's fascinating. So that ends up 2022, and you get to come back next year and tell us all about 2023, which will be great.
Volatility.
Happy New Year. Okay, thanks to Abigail Doolittle for that report on the markets. And now we turn to Laura Davison, who covers Congress and taxation for Bloomberg. That is a perfect position today because we have Congress dealing with former President Trump's taxes. So we've got this revealed now, a lot of taxes here. I'm sure nobody can read through them all, but what do we know, Laura?
Yeah, we have thousands and thousands of pages, and it's really quite incredible. One, just the sheer volume of this is really indicative of just the complexity of the tax code system. Whether or not you're Donald Trump, but anyone who owns a business, even a very small business, has dealt with the complexity here. But there are some unusual things popping up in Donald Trump's tax returns. We got a report last week for Congress that detailed a bunch of issues that potentially would have come up in an audit if the IRS had audited him. We don't know that the IRS has completed any audits. The House Democrats found that they had not. It's possible that he is currently under audit. But a lot of things related to his foreign tax dealings. He had dealings, from Qatar to South Korea, all over Europe. So a lot of intertangled things happening there, as well as some questions also about his charitable deductions. In the year 2020, he didn't donate anything at all, right at the height of the pandemic. So this is something that is getting a lot of attention.
Yeah, one of the things I'm curious about, Laura, I haven't heard anybody suggest yet that anything was done illegally, that there's any actual law violation. And maybe they'll find something, but I haven't heard any suggestion of that. And there are a lot of people with a lot of money who have very complicated tax returns that take some deductions that maybe the rest of us wouldn't recognize.
Yeah, so the tax code is really complicated, and for people who have really high incomes and run businesses, there's a whole basically separate tax code. It's it's itemizing versus taking the standard deduction. And if you itemize, which is only about 5 to 10% of people, there are a lot more deductions that you can avail yourself of here. As for whether Trump did or anything illegal, it's a little hard to say based on without having all the access that an IRS auditor would, seeing the underlying documents that justify these positions that he's took on his tax return. Some experts who have looked at this, say there are some aggressive positions that are taken here. It's things that are, highly unusual, or, deductions for hotel costs or whatever that would exceed what you would normally think would be justifiable. Also payments to his children that may be, that are classified as loans but could be disguised as should be taxable gifts.
Yeah, he wouldn't be the first person to take aggressive positions on taxes. Thank you so much to Bloomberg's Laura Davison. Now we're going to turn to the question of private credit. Recent years have seen an explosion in private credit as investors have increasingly moved away from the more regulated parts of the market. One of the leaders in the growth has been Ares Management. And earlier this month, we talked with the CEO, Michael Arrighetti, about the growth in his business, why it's happening, and the risks as well as the opportunities that it offers.
When we talk about private credit, let me just zoom out quickly. We're talking about lending that is happening outside of the banking system, and that could be in corporate, real estate, infrastructure, consumer. I think a lot of the recent dialogue that folks are paying attention to is more along the opportunity in corporate lending. That's the most evolved and the most developed market, both here in the US and globally. In terms of sizing, no one quite knows, just because a lot of this is in private hands, but order of magnitude, the private credit market for corporates in the U.S. is about $1 trillion. Juxtapose that with C&I loans in the banking system, that's about 2 to 2.5 times that, and almost at parity in terms of size with the leveraged loan and high yield market.
So what effect is the increased interest rates had on the private credit business? Obviously, it's affecting a lot of business right now. It's harder to get loans. If you can get them at all, they're more expensive.
Yeah, I think private credit has tended to outperform when rates are going up for two main reasons. Number one, the structure of the loans are short duration and floating rate, so they typically reprice every 30 to 90 days. So as rates are going up, the return is going up. That obviously in an environment where we're seeing a lot of volatility in the equity markets, and valuations are challenged in the high-grade markets, private credit is a place where people can actually go to benefit from rising rates. The flip side of that, obviously, is that as rates are going up, debt service becomes more challenging for leveraged borrowers. And so part of the conversation today is, as you're generating this excess return, at what point does the incremental interest rate challenge the companies? I would say as we sit here today, still really strong fundamental economic performance within the portfolios, and not any signs of stress really making their way through as a result of the rate hike.
Mike, just pick up on a couple of things you said there, because I talked to one investor who said, there's no such thing as truly bulletproof in business, but these are close to it. And I guess it's because of the two things you mentioned, the short duration and also the fact you got floating rates. So if interest rates go up, you're protected.
Well, I hope that person you spoke to is an Ares investor already, but if they're not, I hope they're watching this show. Bulletproof is always something that you don't want to talk about in investing, but I would agree at this point in the cycle, private credit is a good place to be. Floating rate, as we said, short duration, but also senior secured. So if you think about where these exposures sit in a company's balance sheet or relative to the value of an asset, today most private credit loans are sitting in the top half of the capital structure, which means that there's institutional equity supporting those loans dollar for dollar. So there's a significant amount of equity valuation that would have to deteriorate before you begin to have a conversation about principal loss on private credit.
Mike, you mentioned Ares investors, and I wonder whether you're having, if anything, an easier time in getting investors these days, because interest rates going up necessarily affect the value of equities just because of the discount rate. It makes it less attractive. Has private credit has become more attractive relative to equities as an alternative investment?
I think so. You know, in Ares manages close to $350 billion of assets globally, and we have funds that we offer across the alternative spectrum, including private equity. I would say as a general observation, investor appetite for pure play equity product is pretty muted right now, simply because, as you point out, valuations are challenged. And if you think about the drivers of return in that market, earnings growth is going to be muted, availability of leverage is difficult, cost of capital is high. So private credit does offer some pretty attractive relative value. And I think going into this part of the cycle, a lot of institutional and retail investors were underallocated to private credit. And so when they're grappling with the denominator effect from valuation deterioration in the public equity market and the high grade market, private equity is probably where you're feeling it the most. I think the private credit markets, people are still underallocated. So even though their alternative allocation may be lower, they're able to continue to allocate through that.
I've read also, Mike, that the size of the loans is going up. You can handle much larger loans than you did, say, 5-10 years ago.
Absolutely right. I mean, one of the biggest drivers of the growth in private credit in the U.S. and now globally was just bank consolidation and the increase in size in the public market. So viewed through that lens, as banks have consolidated, it's more difficult for them to service smaller borrowers. And as the public debt and public equity markets have grown and moved towards larger borrowers as well, there's just a much greater white space for private credit and private equity, for that matter, to come in with larger capital solutions. So as that opportunity set has grown, and as folks like us have scaled capital, the average investment size has absolutely increased. Just to put that in perspective, when we started this business 20 plus years ago, a good-sized borrower in this market was probably $25 million of EBITDA cash flow, and today average cash flow in our portfolios is probably pushing 150 million.
How much of the growth of private credit has been because the banks have been more regulated? They have had to move back out of that space. And I guess the follow-on to that is, do you see a prospect of more regulation coming from Washington as private credit's gotten so big?
Yeah, I think that's a little bit of I don't want to say a false narrative, but a misunderstanding of what's been driving the growth of these markets. So bank consolidation is really the primary factor. So if you look at the evolution of private equity and private credit over the last 20 to 25 years, it really started with the consolidation of the middle market bank landscape into the big money center bank. So if you look today, there are 50% of the number of banks in the U.S. than there were 20 years ago. As a result of that, what one may have expected, which was that all of this capacity would have, stayed in the system. The larger banks are now focused on larger borrowers and more liquid parts of the business. The regulatory overlay is less about regulation of the banks and really more about the regulatory capital framework and the profitability of this business on bank balance sheets. One thing that I think is misunderstood by most is that the banks are still very active participants in and around the private equity and private credit landscape. They're just attaching to the business in a different way, lending money to folks like Ares, supporting the buyout business through the syndication of loans. So they're still very, very active. I just think that they've moved away from being primary holders of middle market credit, which, I actually think makes sense.
And finally, Mike, where does the next leg of growth come for Ares and for private credit more generally? Is it taking more market share away from banks? Is it moving into new areas? I know Ares is in the United States, also to some extent in Europe, not in Asia.
Yeah, we're seeing what I would call horizontal and vertical growth. So geographically, we've been expanding into Europe over the last 15 years and now have a meaningful private credit business across the Eurozone. We are now meaningfully growing our business across the Asia-Pacific region. So there will be geographic expansion as these markets continue to evolve along a similar trajectory with a lot of the same trends that we saw in the U.S. There are also new markets that are opening as institutional investors are being more attracted to private credit and the private market ecosystem is growing. We're seeing opportunities in places like infrastructure lending, real estate credit, alternative credit. So I think we're still in the early stages of the development of these markets, and my expectation would be if we can continue to demonstrate durable performance through cycles, then the appetite for the asset class will continue to grow quite significantly.
That was my conversation with Michael Arrighetti, CEO of Ares Management from Wall Street Week earlier this month. Now, to keep you up to date with news from all around the world, we turn to Lisa Matteo here with the first word.
Thank you, David. Italy has confirmed that all samples tested from recent arrivals coming from China are Omicron. Health Minister Orazio Scalacci said on TV, "We are relieved because all cases are already present in Italy." Confirmation eases concerns of new COVID-19 strains imported from abroad. Now, this comes after Italy reported that about half of passengers landing from China in Milan tested positive for COVID. It's being called one of the most intense missile and drone attacks of the war in Ukraine. The barrage rocked cities across the country, including the capital of Kyiv. Ukraine said it shot down 54 of the 69 cruise missiles. Still, it's likely that Ukraine will ask for Western allies for more air defense systems. Vladimir Putin and Xi Jinping hailed deepening ties between Russia and China in a video conference today. Putin says the relations are the best in history. Meanwhile, Xi said China is ready to expand the relationship. Still, there are signs that Beijing is impatient over the political and economic impact of Russia's struggling invasion of Ukraine. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Matteo. David.
Thank you so much, Lisa. Coming up, China's President Xi Jinping is dealing with a COVID explosion at home and increased tensions with the United States over Taiwan. We're going to talk with former U.S. Ambassador to China, Max Baucus, about U.S.-Chinese relations in the new year. And this is Bloomberg.
Go. After hardly a full year of name, image, and likeness deals being a reality, UCLA quarterback Chase Griffin already has more than 20 deals with major brands, venture, and charitable groups, all while balancing graduating undergrad in just 2 years and fighting for playing time on the field.
Chase Griffin out of the gun. We are joined by UCLA quarterback Chase Griffin, not just UCLA quarterback, but name, image, likeness superstar. I am psyched for this one.
This kid could actually be the president of the United States someday.
When it comes to building generational wealth, it's not about the money that you make in college. I'm very excited that I made the amount of money that I made last year. I am even 10 times more excited that I know how to make that money.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Count Under the Close. Welcome to Bloomberg Crypto.
This is Balance of Power on Bloomberg Television and Radio. I'm David Weston. Well, China factored large in the news throughout 2022 and looks likely to again in 2023 as President Xi is going to be taking over his third term as president, and he has his fair list of challenges in front of him. To take us through exactly what President Xi is facing and what it might mean for U.S.-China relations, welcome now Max Baucus, who served as U.S. ambassador to China, and before that represented his home state of Montana for 26 years in the U.S. Senate, including as chair of the Senate Finance Committee. So, Mr. Ambassador, thank you so much. Happy New Year to you. Give us a sense of what you think it looks like to President Xi right now. First of all, COVID-19. They've come off of the zero COVID, but it looks like they got a real problem with infections.
It does. One thing it shows that authoritarian government can turn on a dime. It would be difficult for the U.S. to change policy so quickly, but he has. The earlier zero COVID policy clearly worked at first, but now it turns out to be a significant mistake. Primarily, he's being pushed by his people who are upset with zero COVID. They just have had it. But I think even more fundamentally, it's the economy. The Chinese economy is doing quite poorly. Zero COVID is a major contributor. There are supply chain disruptions. The Ukraine war is part of it. But he has to move to shore up the economy. He's also looking at the United States moving toward more decoupling. It could be the United States is going to put limitations on U.S. investment going into China, for example. And CFIUS is being expanded, and under commerce, export control measures are being increased. And so China sees that and has to do whatever it can to keep its economy going. It's because of some of those U.S. restrictions, and he's opening up because he has to.
So I'm curious, Mr. Ambassador, from your deep knowledge of China, might there be another possible connection between the coming off the zero COVID and the uptick in infections and the economy? And by that I mean this: before it was we're shutting things down, you can't go to work, you can't produce things. Could they be shaking some of the confidence of the Chinese people, and particularly the consumers and investors as well, for that matter? There are reports now that they could have as many as 25,000 deaths a day during Chinese New Year from them all coming back out and being with one another.
There's no question. This is all very uncertain. The reporting in China is poor. There's very little transparency. The Chinese people somewhat trust their government, somewhat don't trust their government. U.S. business is uncertain what the COVID reaction is going to be, and they're starting to pull back a little bit from the U.S., from China into the U.S., but they're also expanding in China, their own operations in China, because they want to sell to that large market. No, everyone's kind of taking a hard look at probably the next couple days, weeks, and months to see exactly what's going to happen with the opening up. But it's quite uncertain now. But bottom line is, I think President Xi is going to do whatever he can to boost the economy. Don't forget, Chinese exports to the U.S. during COVID increased significantly because China was supplying all its medical supplies and even supplying outdoor wear for people staying home during COVID. And also because U.S. injected the American economy with so many dollars. So Chinese export a lot, but that's going to be challenged now. So they're going to try to boost consumer demand itself, and opening up is going to help make that possible.
Coming out of the 20th Party of Congress, I think a lot of us read into some of the remarks made by President Xi that he really wanted to emphasize ideology, that it was the party, it was the Chinese Communist Party first. And if anything, the economy second. Now, I'm sure in his mind, he thinks you can do both at the same time. Do you think that might change if really the big emphasis now has to be on growth again?
Well, for President Xi, it's always been a battle between ideology and pragmatism. The Chinese are quite pragmatic. They like to do deals. They like to do business arrangements. And they're very focused on the dollar and on doing deals. But President Xi clearly is more of an ideologue, similar to Mao. But bottom line, he wants to stay in power. And he's going to stay in power the more the people are happy. And the people are going to be happier the more they're doing better economically. So that's why I underline again, he's pragmatic, but he's an ideologue. But more than anything else, he's going to do what he has to do to keep the economy going, to keep the people happy.
So I wonder how that pragmatism reads against what we're seeing again just overnight. We saw the communications between President Putin and President Xi. As we all remember, the beginning of the year, they said they had a friendship that knew no limits, I think was the expression. And now they've gotten together and sort of said, boy, we really like each other a lot. We're really supporting each other a lot. At the same time, President Xi doesn't seem to have done as much, perhaps, as President Putin would have liked. What is that relationship about, and how does that fit into the pragmatism you describe of President Xi?
Well, it's a marriage of convenience. China needs Putin. It's kind of a common effort against the United States. That helps. China leverage against the United States. China, frankly, needs a lot of Russian energy. There are big boosts in gas exports that China announced just shortly. At the same time, President Xi is not giving all the aid, near military-like aid that Putin would like, because Xi does not want to be subject to U.S. sanctions. So it's tough. But they're trying to help each other the best they possibly can. It's clear that President Xi is quite upset with how Putin's managed the war in Ukraine. It's an embarrassment to the communism worldwide. It's an embarrassment to the relationship, and it's also disrupted supply chains significantly, which has hurt China. But they're going to do the best they can with what they got. That's what people generally do. And I have to remember, too, that Chinese are tough. I use the word pragmatic, and for good reason. They find ways to get stuff done. That's my experience, and I served in China for several years. Very impressed with how tough the Chinese are and how hard they're going to look to try to find solutions.
Well, I wonder if we saw some of that toughness with that military aircraft, that fighter jet that buzzed a reconnaissance plane over the South China Sea, the United States. It came within 20 feet. I'm sure you've seen the video of it. What is China up to there? And obviously, they want to take Taiwan back at some point. They've made no secret of that. But what are they doing? Do you expect that they will actually make more moves against Taiwan?
I think China's making it clear that they're not backing down, that they are, according to their view, going to eventually, hopefully from their perspective, and ours too, take Taiwan back peacefully. So I think we'll see incursions like this. It partly depends on what the U.S. does. The more the U.S. stands up for Taiwan, and even sends signals that maybe even support Taiwan if Taiwan declares independence. That would be a big mistake if Taiwan were to declare independence, and be a mistake for the U.S. to support Taiwan, I think, if that were to happen. But if we keep our cool as Americans and don't cross that tripwire, I think you'll see not quite so many more incursions. But if the closer we get that tripwire in Taiwan, the more it's going to upset China. We're going to see China showing, hey, we're not going to let that happen.
And Mr. Besser, I wonder if China may be moving a little bit the other way toward U.S.-China relations, with now they're going to appoint the current ambassador from China to the United States, Jin Gang, to be foreign minister. I don't know if you know him or not, but some people are reading into that that's a move to try to have a more constructive relationship with the United States.
I agree with that. I know him quite well. I've met with him several times, had dinner, lunch with him many times. I'm very impressed with him. He's very close personally to President Xi. That's a benefit for the relationship. He'd been in America. I wish he'd spent more time in America. I urged him to travel around America as much as he possibly could, and he's done a bit of that. He's been in the Midwest. He drove a Tesla. He's done several things. But he's smart. I like him. I think it does send a signal that from China that, hey, we want to work with you Americans. It's so important that we do. I think we're making a bit of a mistake in the United States by treating China too much as an enemy. And the more we do that, the more China's going to become more like an enemy. The more we're going to have a Cold War opponent across the Pacific. And that means China's going to double down. It's going to be a hunker down. It's going to be less likely to work with us. And already we're seeing results with China is not helping us with fentanyl precursors. For a long time we were making headway. When I was over there, we were making headway with precursors for methamphetamine, and now we were doing okay with precursors for fentanyl. But now, because of the tight relationship between two countries, China is not helping as much as they otherwise would.
One last one, briefly, if we can. Do you think the new Congress will have a different relationship with China? Will they have a different position?
I think the new Congress will be marginally more aggressive, more hawkish toward China. It's a Republican House. That's one reason. Second, we're approaching the 24 congressional elections, the 24 presidential elections, and we're going to see a lot of candidates, particularly on the Republican side, position himself to show that he or she is more hawkish than the other, because that's good politics.
Yeah, exactly. For better or for worse, it looks like it doesn't hurt you as a politician to be tough on China right now in the United States of America. Okay, thank you so much. And once again, Happy New Year. That's Max Baucus. He's former U.S. Ambassador to China and for a good long time, a senator from his home state. Check out the Balance of Power newsletter on the terminal and online. That does it for this extended simulcast of Balance of Power. Stay tuned for Bloomberg Markets with Bryce Doty, Senior Investment Associates, Senior Managing Partner.
What about cryptocurrencies? Are you a believer in cryptocurrencies?
No, I'm not a believer in cryptocurrencies. And I would say that cryptocurrencies are a bubble. And I would describe cryptocurrencies as a limited supply of nothing. So to the extent there's more demand than the limited supply, the price would go up. But to the extent the demand falls, then the price would go down. There's no intrinsic value to any of the cryptocurrencies, except that there's a limited amount.
Well, based on what you just said, why would you not put a big short of some type on cryptocurrencies? Or maybe you have, but do you think that's a good short?
Well, you know, when we look for these subprime, the reason why we shorted the subprime in size because it was asymmetrical. You're shorting a bond at par that has a limited duration that trades at a 1% spread of treasury, so you can't lose more than the spread in the duration. Yet if it defaults, you can make the par amount. In crypto, there's unlimited downside. So even though I could be right over the long term, in the short term, as the case of Bitcoin, you know, went from 5,000 to 45,000, you know, I would be wiped out on the short side. So it's just too volatile to short.
We were thinking big from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
The top names in business are on Bloomberg.
I think you have to assume that we have some bumpy times ahead, and you have to be a little bit more cautious with your financial resources, with your sizing and the footprint of the organization.
So what can you do near term? Test to make sure you see at the margin you can move things around, manage your expenses very carefully and invest in efficiency and effectiveness, but also continue to spend money where you have competitive advantage.
Nobody covers business like Bloomberg, your global business authority. When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
In like a lion, out like a lamb, a market that began the year at record highs, closing out the year in a bear market. A bear market now effectively in its 7th month here on this final trading day of the 12th month of 2022.
Can we call it a lamb?
Well, something, yeah, because it's basically been slaughtered this year.
It's a tired lamb.
Thank you. I love your analogies there.
You're welcome.
Tim, you have something to add?
Yeah, I think today's trade really just epitomizes the entire year with tech dragging everything down. That's what's happened.
Are we looking at this on a daily basis today?
I'm looking at a daily. Today? There are movers to the downside today.
Do we care about these movers?
I do.
Okay.
We always do.
All right.
Nothing gaining. Very much the opposite of what we had yesterday.
We should just point out, I mean, just real quickly, though, on the broader markets, we're right around 3,800 here on the S&P 500. In fact, 3,800 was the low of the day. We're down about 1% here. And again, volume remains light here on this holiday shortened week. But I think this is really indicative, I think, of the sentiment, the real sentiment shift. Because remember, we had that big rally in the summer, and I guess that kind of spilled into September, October. And then, I don't know, people just decided, no, it's just not happening.
Was it Jay Powell who decided that?
Well, Jay Powell has decided everything.
Yeah, he has. And whenever there is a little rally, he comes out and squashes it. You know what I was thinking about today, Romaine? It's a year ago today. We were in here for the entire week between Christmas and New Year's. And it was record after record for the S&P 500. What a difference we're seeing this year.
Well, it's a reminder that markets don't always go up. And there are folks out there certainly coming off the financial crisis where we thought money's going to be cheap. You know, we're going to see maybe anemic growth, but some growth, but, you know, all in on equities in various asset classes. But it's been a very different tone, certainly, this year. All right, so very hard to find some gainers. So please do not judge me. That was for you, Romaine.
Okay.
Because I don't really have any real reasons why. I know.
Seems like a lot.
I know. Yeah. You're impressed. I can tell. Take-Two Interactive up 1.6%, topping the S&P 500. You know, the video gaming company. No real reason why. I will say it's down more than 40% so far this year. Yeah. I'm going to sound like a broken record. Earlier in the week, though, we did have Baptista Research come out with a new buy on the stock. $127 price target. It's at 102 and change, almost 103 in today's trade. So I'm going to put that out there. Two names, it's going to make sense. They've been on a tear since we've seen China do that 180, start to open, roll back that COVID zero policy. So these two names, Las Vegas Sands and Wynn Resorts, both have big exposure to Macau and China in terms of gaming. So Las Vegas Sands just up about 1.3% in today's trade. It's up some 36% since late October. Wynn Resorts up about 0.5% in today's trade. It's up about 46% since late October. So those have been some outperformers, at least in the later portion of this year. Tapestry, I have no idea why. It's up about 0.7%, up about 33% since the end of September. So those are some of the names, Tim, that are at least a standout in today's overall downward session.
Well, speaking of a downward session, the stocks that are dragging on the S&P 500 and on the NASDAQ 100 are those stocks that have really had an outsized influence on those two indices throughout the year. We're talking big tech, mega cap tech, and consumer discretionary as well, with Amazon down 1.6% today. Shares down about 50% so far this year. It's set to be Amazon's worst year, going all the way back to 2000 at the height of the dot-com bust. Alphabet shares down 1.6%, its worst year since 2008, down 40% so far this year. Microsoft down 1.5% today, its worst year since 2008. Shares down around 30% so far this year. Got to throw an Apple in here, even though it is outperforming the market today. It's down only 1.08%, but shares are down about 28%. Most since 2008, that was when it fell about 56%.
A lot of these superlatives, of course, going to go back to the global financial crisis in 2008 and 2009. I mean, Carol, you started off talking about, of course, that record high that we hit on the very first day of this year, but you really can't talk about 2022 and the look ahead to 2023, which we're going to do a lot today here, without really going back to 2020. You talk about that sort of big pandemic sell-off and what ended up being the shortest bear market in history. That relaunched a new bull market, and of course, that came to an end on January 3rd. And ever since, it's basically been a downward trajectory. You could sort of look at all these little rallies we've had, but you put a chart line on there with those moving averages. The trend has been down for most of the year.
I do think that there were some strategists who were talking to us about, listen, you're going to see a lot of volatility, that it wouldn't be a surprise that by the end of the year, maybe we haven't made much ground, certainly to the upside. I mean, what we have done is a lot of fair ground here to the downside. But one thing I think for sure was a lot of volatility. And I think that has to do with the mixed messaging sometimes, or at least traders thought in terms of what the Fed might or might do. That whole talk about pivot, I'm kind of tired of.
I don't know. I think they
the
were
Fed's going to tell us when they are going to change policy.
I think they were just in denial, these traders. I think the message was loud and clear. And I think, every time there was some sort of optimism or some sort of economic indicator that showed that inflation was coming down, there was this optimism that you'd see in the trade. Yeah. And then Jay Powell would come out and say, guys, this is a long road ahead.
Yeah,
We've got a long way to go.
We got some data to back that up. We're going to talk about that a little bit later. Save it up for that so you two can fight it out.
Yeah.
I do think it's interesting. We talk about all the losses this year, and there have been some pockets of this market where a lot of people have made money, but then other pockets where it's actually caused people to rethink. There was an interesting story on the terminal today about Tiger Global Management, which of course was a traditional hedge fund. A lot of people seem to forget that, and it's sort of morphed. I guess you call it a VC fund now?
Yeah, it's pretty dramatic in terms of the change.
Okay. But just because an asset isn't traded
I don't know where he's going to go here.
Just because an asset isn't repriced each day doesn't mean it hasn't lost value. It's kind of this bone that I have to pick when it comes to the way that private equity and the way that private investments are actually valued. Because if you're not marking those to market, it doesn't mean the value.
I hate to break this to you, Tim, but value is whatever you want it to be.
All right, it's whatever someone will pay for it, right? My dad once told me that.
Yeah, the crypto community loves it. And anyway, of course, we're going to continue to look ahead here in 2023. Some big changes in Washington as well. Some departures out of the Biden administration we're learning today, and of course, a new Congress coming in January 2023. So a big setup here for investors as we move out of 22 into 2023. Pleased to say joining us right now to talk a little bit more about this is Bryce Doty, old friend of the program. Joining us here on the stage is Senior Vice President, we should point out, and Senior Portfolio Manager over at SIT Investment Associates. All right, let's get right to it, Bryce. You go back to the beginning of this year and you look at some of your worst fears, some of your worst predictions here. Did the markets actually meet that? Did they come in higher than that or lower than that?
It was an incredibly difficult year in 2022. We were very pessimistic. We saw the Fed is way, way, way behind the curve. Just over a year ago, their 12-month forecast for Fed funds was less than 1%. I mean, we knew they were going to have to pivot then, but not to this degree. No, we thought it could be the worst bond market in history, which we're thinking maybe down 5%, not 13 to 15%. I mean, it's just an incredibly terrible year because, the Fed was so far behind the curve that by the time they did try to catch up, it was just so extreme that in such a short period of time, that it just really blew everyone away. And so that obviously bled over into the stock market and caused the combined market, stocks and bonds, to just be shockingly bad. Having said that, it does set up for a much better 2023. The Fed can't raise rates another 4%. There's so many things that are.
Paul Volcker saying, saying from the afterlife, watch me. I could do that.
Well, there is that. And as a bond person, we're just naturally paranoid. We're always thinking about the downside. So it's been kind of strange lately to have this sense of optimism for 2023. I'm like, what was that? I forgot what it felt like to be optimistic as a bond person.
Bryce, the one thing I would say is, I hear you. I mean, it felt so miserable. And to see both the stock and bond market just take a big hit, to see that correlation, that's not what's supposed to happen. Having said that, what is it that gives you certainty that you feel like you can start to predict 2023 at this point?
Well, I think inflation being at 10% in 22 is just horrific. And 23, people are equivalent about it being somewhere between 2 and 4. I'm like, hey, you can buy investment grade bonds at 5. We're automatically, at least within you can conceive a real yield. That is a complete game changer. So I see inflation coming down much quicker than I think other people do, because they don't realize the way the math works is if oil is at 80 and stays at 80, that's zero inflation. So I'm not calling for deflation like a lot of people think it has to go back to where it was in 21. No, prices could just stabilize where they are and we'd have zero CPI. So those kind of things are what give me a lot of optimism. I think the Fed's got 2 more rate increases in them, and that's it.
2 more rate increases of 25 basis points each, 50 basis points. What do you see?
I'm trying to not be pinned down, man. So I think it'll be 50 and 25.
A very wise man said to me earlier today that, everybody's speculating about what's going to happen in terms of the Fed and market outlooks. You know, a lot of them got it wrong this year. So what is really the smart conversation? Is there something that you can really kind of hang your hat on here?
Who is this wise man? Did you just make this person up?
You know him well.
Okay, all right, just checking.
It's not me.
Well, the economy is transitioning from stagflation, you know, zero growth with 10% inflation, to stagnation. We're going to have another year of zero growth, but we're not going to have 10% inflation. So it's a different animal, and that's a tough market for stocks. Fine for bonds. But stocks were getting earnings boosts by purely inflation. They're not going to get that lift. So the first half of the year is going to be a little tough, and there's going to be some misinterpretation about what's going on. One real problem with the way Powell is looking at things is that he sees this cost push inflation from wages that's just not going to happen. Wage inflation or wage increases were trailing CPI for the last 18 months. So that's a rare situation where you have negative wage growth. It's going to flip back to positive. That's what it normally is. It normally outpaces inflation because of productivity. And he's going to misinterpret that. He's going to think, oh no, that means it's going to feed into forever inflation, this vicious cycle, which it doesn't. And so that's what's really going to cause the stock market headaches, because people that will wait for the pivot will get disappointed, back and forth. But by the time they finally capitulate and say, oh, wow, wages have been going up, and it hasn't been showing up in CPI. And in fact, when you use new rents for core CPI is pretty darn low. People will start to look at a 3-month annualized CPI rate instead of the year over year. And when that transition happens, and that'll be like February, March, you better be fully invested in stocks, because they'll pop.
All right, we're going to leave it on that note. Hey, Bryce, thank you so much. Bryce Doty, Senior Portfolio Manager at SIT Investment Associates, joining us there via Zoom. You know, I got to say, I feel like we do have a more filled playbook when it comes to 2023, whether it's the war, because the war is not going to surprise us. It's either going to end, it's going to continue, but we've kind of got that checked out. I still think we're understanding that global supply chains are changing. Like, there are things that are out there that if it hits investors once again, it's going to be like, well, wait a minute, we know that this is going on.
Yeah.
I mean,
well, you hope so. I mean,
well,
of
I
course,
hope so, right?
You could have said the same thing at the end of last year.
Inflation, right? At this point, do we really anticipate it's going to go much higher?
No, and it's interesting. One thing I thought that was interesting in Bryce's comment, specifically when he was talking about oil prices, actually the new Dallas Fed survey, where they survey all the big shale executives, like 150 of them or something, just came out. You know what their average price is that they're looking at for
no idea.
$84. So that's basically where we are right now. We're basically around 79, 80.
Right. And we know we've seen incredible swings, right, in the energy markets.
Yeah. Well, let's get up to date on the latest news from around the world. Let's get on over to Madison Mills with an update. Hey, Maddie.
Thanks, Tim. The UK and France will require all travelers arriving from China to test negative for COVID. That's according to The Times, citing a government source. The report says Prime Minister Rishi Sunak stepped in to order those tests. In addition to having to show a negative test, up to a fifth of those arriving from China will also be tested again on arrival. That policy comes just after European health officials called restrictions on travelers from China unjustified. And some startling estimates of just how bad that COVID outbreak in China could be. According to London research firm Airfinity, there could be as many as 25,000 deaths a day. Daily infections could peak at around 3.7 million cases from the virus during Lunar New Year celebrations next month. It's been difficult to get accurate data since the COVID zero policy was lifted. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Madison Mills. This is Bloomberg.
All right, Maddie, thank you so much. Coming up, we'll take a look at the year that was, FX, commodities, so much more, and what's to come. This is Bloomberg.
What's happening on Wall Street?
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
You know, Carol, maybe about a year ago, I was sitting down talking to a very wise man. And he said, you know, for 2022, getting the macro call right, and more importantly, getting the FX call right was really going to be a big determinant of whether you got the equity call right. And that turned out to be very prescient. Of course, at one point on the year, we saw the Bloomberg Dollar Spot Index was up about 15% on a year-to-date basis. Of course, it has paired a good significant number of those gains, but still going to close out the year stronger by about 6% here. And now I think this is going to be the first back-to-back annual gains we've seen going back to 2015. 2016. Here to talk a little bit more about that is Sydney Mackey, Bloomberg News reporter who covers the FX space for us. And Sydney, I think everyone really wants to know is the dollar strength that we saw, which quite frankly has faded pretty significantly since we hit those peaks a few months ago, whether that's going to flip to dollar weakness in 2023.
Yeah, that is exactly the question that everybody on Wall Street is asking right now. Of course, we had those huge gains earlier in the year, driven by a few things, by the Fed's very fast and large rate hikes, but also just this demand for a haven amid a lot of the uncertainties of 2022. So as we get into 2023, the question is what happens next? Fourth quarter has already given us a few hints, a few indications of what's to come. It has not been a great quarter for the dollar, and that's given other currencies, both G10 currencies and emerging market currencies, a little bit of room to come back. So weakness in the dollar is what many on Wall Street are expecting going forward.
Hey, Sydney, you know, currencies, global currencies, they don't act in a vacuum, right? It depends also in terms of what's going on around the world, what global central bankers are doing, and especially when you see, you know, monetary policy not all act in unison. So tell us about that part of the story and how that impacts what we see from the dollar next year.
Yeah, absolutely. And this is something else that we have a couple clues on from this quarter. As investors started thinking that the Fed will either halt or start to slow the pace of their interest rate hikes in the coming year, that's when we started to see this turnaround in the dollar. So looking ahead, what the Fed does, what the ECB does, what some of these large major central banks do will be huge for currencies. The BOJ will be one to definitely watch. The yen underperformed pretty heavily in 2022. So if the December tweak of the yield curve settings is anything to indicate what's to come, we could see a comeback in the yen as we see more of a convergence with that monetary policy and what's been going on with the Fed, ECB, and others.
And we've seen that from the Bank of Japan, certainly this week, in terms of intervention and impacting what we see for the yen.
And Sydney, obviously central banks and what monetary policy does around the world has a big effect on dollar strength. But I'm wondering about macroeconomic events that are beyond the central banks around the world. In terms of thinking about 2023, what's on the radar of the sources you speak to about, you know, what could lead to dollar strength or weakness?
So inflation, of course, is the big one. That's a major indicator of what the Fed is going to do and what central banks will do. So if we do start to see more and more signs of inflation cooling, that will be something that currency traders are keeping a very close eye on. And then, of course, we heard people talking about the risk of a recession and how likely that is, how deep a recession could be, and how long one could last. That'll be something else to keep in mind. And the dollar is interesting because, of course, it's the world's reserve currency. So it's where investors go when things are risky and scary. So that safe haven trade will be one to keep in mind as we go into the year ahead.
Sydney, I want to pivot a little bit away from just FX specifically and talk a little bit here about short-term money markets in the U.S. There was a redhead on the Bloomberg terminal a little while ago here, maybe about an hour ago, about the reverse repo facilities. And we've seen that usage this year, of course, set record after record after record. And that looks like how we're closing out the year. And I am curious as to whether some of the conditions that have led to that are going to persist into next year.
Yeah, so that's a good point. Of course, the year end and quarter end tend to be pressure points for short-term funding markets. And for this Fed facility, more broadly, the end of the year is a moment in which financial institutions want to put their cash somewhere, shore up their balance sheets for regulatory purposes. So this year-end spike that we saw today was huge, like $245 billion increase, taking the use of that facility up to, I think, $2.5 trillion. It's the biggest ever. And a lot of those factors that have caused financial institutions to want to put short-term cash somewhere instead of putting it into longer-term investments are likely to continue, at least until we see some pretty large shifts in the more macro picture.
Yeah, Sydney, do we see that as a sign of nervousness? You know, going to the numbers, as you said, 113 participants today, putting a total of $2.554 trillion at the Fed's overnight reverse repurchase agreement facility. That was $245 billion more than the day before, the biggest one-day increase ever. So for investors who are thinking about, and obviously on pause today, thinking about 2023, is that a sign of some nervousness when it comes to the financial community, or just kind of business as usual?
It's a good question, and that is something that I'm trying to figure out today, is whether this is some kind of combination of jitters as people are going into the year ahead. In all likelihood, it probably is a combination of these folks need somewhere to put the money today, given this end-of-year pressure. It's the final business day of 2022. But it'll be extremely interesting to see how it goes as we get into 2023, and if usage of this facility, which has only been around for a handful of years, continues to rise. 2022 was a huge year in which we saw leaps and bounds in terms of usage. I think it ended 2021 with usage below $2 trillion.
Sydney Mackey from Bloomberg News. Sydney, thanks so much for joining us. Happy New Year, too. I really appreciate you taking the time today. Well, let's go from foreign exchange, from currencies to commodities now, and bring in Bloomberg's Joe Doe for more on what to expect in 2023. Joe, I want to just start with copper and what we've seen this year. Copper heading for an 11% gain this quarter, still an annual loss of 13%. We like to look at industrial metals, of course, for ideas of strength and weakness in the economy. What are you watching in the early parts of 2023 when it comes to your space in commodities?
Yeah, Tim, I think what most traders have been saying over the past month is things might be a little bit bumpy to start the year. We had Nucor Corporation. Now, I'm not talking about a copper company, but I am talking about a steel company. Nucor is the largest U.S. steel maker. And they said, listen, we are cautiously optimistic, which is not phrasing that you usually hear from steel companies. They always just say things are great. But we are a little bit concerned that in the first quarter, we could see a slowdown of activity, and we are keeping a lookout for a potential recession. Now, U.S. Steel, the other competitors didn't use recession verbiage, but it was interesting to hear Nucor say that. And I think going back to copper, Tim, I think copper, steel, any of the industrial metals, it doesn't matter which one you're in right now. They're all kind of thinking the same thing, right? There's a concern that in the spring, you're not going to see new construction projects being signed and sealed, delivered, right? New money put down. And I think a big part of this all goes to the interest rate question. Think about it, guys. We have spent 15 years with near 0% interest rates.
Yeah.
For any trader or for anybody who had to carry metal or put it on inventory, there wasn't much that they had to worry about in terms of holding on to that and paying back, 180-day terms, right?
Right.
Well, now that interest rate has changed, and suddenly all these people are saying, oh, great, well, to get the same all-in price, I got to pay back, my loan or holding over 30 days or 60 days.
I am curious. It's an interesting point about the carry trade, Joe, and I am curious that given that, I'll be careful how I say this, but given that we might sort of be at the end of this hiking cycle, does that bring a little bit more stability that you're not going to necessarily have the volatility in those secondary market rates if you have some sense here that another 50 points is probably, or 75 is probably it for the Fed?
Yeah, and listen, that's what a lot of people are out there are talking about. I spoke to the CEO of Stelco, which is the largest Canadian steel producer, just a couple weeks ago, and that was his argument. He said, listen, Joe, first half of the year, I'm not writing home much about it, right? It's probably going to be sideways. But in the back half of the year, we'll get some of these recession worries out of the way. The Fed will finally be caught up to inflation and things will normalize. We could probably expect things to improve by the end of the year. And of course, so many people want to talk about 2024, but I keep saying, okay, guys, come on, seriously.
Let's 1 year at a time, Joe. Before we let you go, and I know you don't really cover specifically what's going on in the LME here, but I mean, I was looking at kind of the best performing commodities of the year, and one of the best performing, at least on a percentage basis, is nickel. But we know that is an incredibly broken market. And I'm wondering if you've heard from anyone that you've talked to that they expect some sort of right sizing of that, or even maybe moving those contracts off of the LME to somewhere else more reliable.
Romain, I feel like you and I talk about this market every month since February or March, whenever the market actually went haywire. And I think traders especially and buyers are kind of in the same place that they've been all year, which is their confidence in the LME is still stained. And they're looking for other avenues now. And I think that's the thing we've been looking at lately.
All right,
in our
Joe.
report.
Great stuff. We got to leave it there. Have a happy New Year, my friend. Joe Doe there for Bloomberg News. Don't go anywhere. Tim Stenovic, Romain Bostic, Carol Masser. We'll be back in a moment. This is Bloomberg.
Most of us don't spend much time thinking about the grid, the dizzyingly huge system of cables, transformers, and outlets that reliably powers our lives. It's an easily ignored, change-resistant part of the modern world, and that's the way we like it. But as we move towards less planet-melting ways of producing electricity, the grid is going to have to evolve too.
We're seeing so many countries and governments announcing high targets when it comes to decarbonization and being climate neutral. But this is just one side of the coin. It's not enough to simply generate green energy. We also need to make sure that this is transmitted and distributed to the end consumers.
The grid of today just isn't equipped for renewables. So a new kind of grid is starting to take shape. The supergrid.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to Bloomberg Markets to close here on this final trading day of 2022, about 2:30 here in New York. Let's get you caught up on what's happening in the commodity space. Watching settlement right now of NYMEX crude futures higher here on a daily basis and now higher here on a yearly basis as well. Up about 2%. Looks like it's going to settle right around $80 a barrel. We should point out on a year-to-date basis, up about 7%. Brent crude up about 10%, well off the big monster gains that we saw through the first 4 to 5 months of the year. We were just talking with Joe Doe about the nickel market, down about 0.7% here on the day here. Still up about 44, 45%, but a lot of those disruptions that we saw early in the year never really seem to actually get right size here. So don't read too much into some of those prices in the nickel market. Two other interesting movers on a year-to-date basis that I thought were pretty interesting. One of the best performing commodities out there this year, coal. Yeah, how's that for all you ESG folks?
I thought we were turning it back on coal.
Coal price, well, no, not when you need it. Yeah. Coal price is up about 0.8% on the day, up more than 60% here on a year-to-date basis. Looking at prices right now over in Rotterdam, close on the day here, but just gives you a better sense here of what we've seen on the year. And lumber, which of course was all the rage back in 2020 and 2021, down 2% on the day on settlement, down 68% on a year-to-date basis right here.
What a different year.
Settlement. Right. Now that's a chart that I would like to see. There are a lot of other charts that I think we can also look at that I think really illustrate the ups and downs that we've seen this year.
Let's get to one in terms of global inflation. Folks, you know, you listen to us, the three of us, and we talk a lot about the U.S. inflationary picture, but we do, of course, focus on what's going on because it's a global inflation problem. Take a look. For those on radio, we're showing a chart, and it just shows the dramatic run-up that we've seen in inflation starting in about 2021, kind of a straight run-up. We know the reasons why, right, in terms of supply-demand out of whack, global supply chains coming undone. And you could see it kind of start to level off and top off, certainly, in the last few months. Can I just point out, though, the Eurozone, worst year for inflation, 10.1% in November. Record year for interest rate increases in Latin America. Check this out. 7 CPI targeting central banks have hiked 57 times, good for 3,975 basis points.
Yeah, and that's interesting, too, because you go back, I don't know, a year and a half or so, when everyone was saying that's when we start to see the tick up, the idea of it being transitory, the idea that there were sort of more structural issues with the pandemic, and then when the pandemic was over, it would go away, and then eventually, maybe almost about a year ago, Jay Powell finally got religion and realized that they had to do
backed off.
Yeah. So what about another chart when it comes to economic growth and talking about the way that we're thinking about economic growth in a post-COVID environment, an environment where interest rates are no longer at zero, where inflation is high, where pandemic recoveries are losing momentum. Check out this one, 2021, global growth, close to 6%. We're looking at pretty anemic growth over the next few years globally, sub 3% projected in 2023.
But that's normal. And I know there's going to be a lot of hay made over these projections because I think most of the projections are wrong, 3% to 2%. Well, not just about being wrong, but everyone's fretting because everybody sort of wants to put it back. You have that big spike up in 2021. You have a lot of distortions on these averages. But when you talk to older investors, people who have been through multiple cycles, they'll tell you, look, if you can get 2 to 3% growth, at least in the major economies, for markets, that's pretty darn good.
Much better than a recession, right? Much better than negative growth. And part of the problem is that growth gets certainly tainted, and it's a whole different story when you're dealing also with high inflation rates, right, in terms of our purchasing power and what it ultimately means. But this is the question for 2023. Do we get that soft landing? Even if we get a little bit of growth, that's much better than any kind of recession.
Any other charts out there?
Yep, interest rates.
Interest rates.
Want to go there?
I'm guessing they're higher.
Did they go up?
Did they go up? Yes, indeed. I just talked about what's going on in, Latin America. I mean, they have been on a tear. Here's a chart for you guys on radio. Again, no surprise. Central bank benchmark rates.
This is being broadcast on radio?
Yeah, well, this is a simulcast, Romaine.
I'm so glad you realized what we're
Friday.
doing.
By Friday, he gets it.
Anyway,
when do we do traffic and weather?
Again, I'm going to ignore the boys, let them do their things. But if you look at 2022, for you guys on radio, it's just, a straight mountain up, if you will, in terms of what we've seen for global interest rates. But I do wonder, too, what?
Yeah, well, I mean, this chart really says it all. I mean, you talk about the end of what was effectively a zero-bound world, and let's face it, really a negative yielding world when you consider that so many nations were actually had a negative sign in front of their benchmark rates here. That's it. Easy money. It's over.
But what's the anomaly? Like, keep that chart up for everybody on TV. You're going back to, 2016, 2014. We know we had easy money for so long.
Right, 2014, 2022. You put that chart out back before the financial crisis.
Right.
And you get a better sense here of just how distorted things have been.
I mean,
so
if you
is this
pull
more
this
normal
is
bringing it in?
That's what I was going to say, a reversion to the mean.
This is normalization.
aversion to the mean.
And I want to hear, can I just say that? Am I allowed to give opinions? I want to hear Jay Powell, or at least someone
Disclaimer, please, for Romaine.
Talk a little bit more about the normalization of policy. Because remember, they did start to talk about that prior to the inflation really getting out of control, and they had to pivot and just focus on inflation labor market. But there has been this sense, and the Fed did a lot of papers on this, saying you cannot stay at the zero bound forever, and there has to be some normalization.
But the problem that you referred to earlier this week, Romaine, for anyone under the age of 40, they've never lived in an environment where we've essentially been adults as rates haven't been at zero.
I have no friends under the age of 40 as a result.
Oh, I'm your friend.
Are you under the age of 40?
I'm your friend.
You look good for your age.
I'm your friend under. Okay, we have a great guest to talk about what is normal as we are in this final trading day of the year. Let's get to it. Let's bring in Kayla Brune. She's an economic analyst at the decision intelligence company Morning Consult. She joins us from Washington, D.C. Kayla, it is good to have you here with us. What is normal in a world where for a decade or so prior to the pandemic, everybody was used to very low rates, easy money, a very different environment? Was that abnormal, as many would say, versus what we're seeing today?
So good afternoon. Thank you for having me. And that is a great question. And I think a difficult one to answer. Definitely, we had settled into what felt like a period of normalcy pre-pandemic. And what we've been experiencing since the start of the pandemic is definitely not normal. As you could see from 2022, what we've seen with inflation. I do think 2023 in some ways may bring about a bit of a rebalancing. Some of these crazier dynamics that we've seen lately may start to reshuffle a little bit. Maybe some of the industries that have been going above trend in this recovery are now starting to normalize a little bit, and some others may still be catching up. So I see potentially this could be a year like that.
I am curious, Kayla, about when we talk about trends, because there are a lot of people that sort of are looking, or at least hoping for some degree of mean reversion, at least when it comes to certain asset classes. And I'm wondering if there has been so much damage from the pandemic, from inflation, and from the Fed's and the central bank's fight against it, that it's almost impossible for us to go back to that, at least not in the short term.
It varies a lot depending on which market you'd be talking about. Take housing, for example. Right now, we've had this very dramatic collapse, but that's coming up against many years of kind of chronic undersupply that we've sort of seen since the last housing collapse. So in that case, even though we are seeing this very dramatic correction, I do think that there's sort of a floor there that's going to present values from falling too much because it's up against this longer term trend of chronic undersupply. So it varies a lot from market to market. It's different with labor markets too. There are certain industries that still have some room to grow to recover to their pre-pandemic level, which are constituting some of the growth.
Kayla, that's exactly where I want to go, is the labor market. One area of frustration, I think, for Jay Powell has been the resilience of the labor market. He mentioned several times this year that it's unsustainably hot. When will we start to see some sort of cracks when it comes to labor in this country? And are those cracks going to actually get so big that they're going to start to be a concern where we do see widespread job losses?
Can I just argue, is it his frustration, or is it also some of his saving grace? Because it allows him to keep, you know what I mean? The economy hasn't fallen apart. Anyway,
that is a really good point. I mean, and I don't want to be, looked at as somebody who's like cheering for job losses here, but he's called the job market unsustainably hot several times this year.
Yeah, and I think a lot of the concern with that comes from the wage gains that come along with it when we still have labor force participation below where it was pre-pandemic. And certain of these sectors, a lot of them tend to be sort of lower paying services sectors like leisure and hospitality, health services, things like that lost a lot of jobs in the pandemic and are still growing. Those are the ones that are still contributing to jobs gains the most. And where we're seeing a little bit stronger wage gains. And the concern with that is that those wage gains stick into that services component because it's a cost input for services and keeps inflation elevated. So that's kind of the concern with that. To the start of your question, though, we have started to see definitely some cooling in the labor market. But I think because these sectors that are still growing are bigger ones, I think it's not making it show up at the top line as much.
And that's an interesting point. And the focus, Carol, I think, on wages. I mean, I understand why, but that wage growth, the spiral, if you call it that, that's also fueled, of course, a lot of the consumer spending as well. And last time I checked, that's still a huge component of this economy.
Yeah, huge. Well, and let's go to it, because, one of the things when we were planning on our planning call this morning, Kayla, is, Romaine was pointing out you guys have so much important data. What are you seeing when it comes to consumer spending? That is the backbone of our economy.
Absolutely. And that's really the area that I actually spend the most of my time watching. And I'm definitely keeping a close eye on it at the start of 2023. My big concern is that consumer budgets are just starting off 2023 in a much weaker position than they did in 2022. We see in our surveys that we collect from among consumers that it's been rising all year, the share who are saying that their monthly expenses total more than their incomes. So they've been working away at their savings. Debt levels have been increasing and getting more expensive with interest rates. So all of those factors, I think, are making the consumer a bit weaker. What's been surprising is how resilient spending has been so far, but the question now is kind of, are incomes going to close the gap enough with inflation to kind of allow them to keep spending? Or, we're seeing more price sensitivity. The holidays were a big toll on many. So are they going to be able to sustain positive growth in 2023?
Well, I'm curious, Kayla, when you look at the data that we've gotten so far, and I'm particularly talking about some of the ratios with regards to credit balances, debt servicing, household debt servicing, and things like that here, have any of those ratios given you concern? Because when you point those out to certain people and you say this could be bad, they say, well, you have to compare it to, the financial crisis and other sort of recessionary periods that we went through. And they say, well, it's not bad when you stack it up against that.
Yeah, I agree with that. And I think that certainly was what helped us throughout 2022. We've kind of only just gotten back to, pre-pandemic debt levels or debt utilization as a share of income. But what worries me is that you think about what do consumers use to spend? They have incomes, they have savings, they have debt. And where we are now is they've worked their way through their savings to a larger degree than they did at the start of last year. Incomes are still not keeping up with prices. If that changes, that could help. But for now, purchasing power is going down. And then debt levels is that final piece, which has not been a big concern in 2022. I'd say we're kind of back to neutral now. It could be a bigger piece in 2023.
Can we just mention for our radio audience, it was an incredible chart. Let's throw it up again for TV. It was inflation-adjusted wages falling for 19 months. So we saw that individuals, based on the inflation picture for a long time, were doing okay based on what they were being paid. But the last 19 months, that's not been the case.
And this is a brutal chart. And
brutal.
I know that a lot of the data we get, it doesn't have the luxury of being inflation adjusted. Obviously, you can kind of do the math yourself here. But I think if you see more of these charts on an inflation adjusted basis, it would cause a little bit more concern, I think, out there.
Yeah, I think so too. But if inflation does indeed come down, then so our purchasing power essentially increases, then we could start to see a difference there. That could be if. I know if is the key. That could be.
And what's the lag time? I mean, we talk about just the psychology of these markets, and more important, the psychology of the consumers. It's not just whether they have the capacity to do things; it's how they feel. Is Kayla still there?
Kayla, you're still with us, right?
I'm still here.
I mean, in all seriousness, I don't remember who said it, but I don't remember years ago. It was one of the some political candidate was talking about how the economy really is a feeling. For most people, they're not looking at charts like that. It's how they feel, and if they feel things are bad, it's going to be bad.
I'd say we certainly saw that with our index of consumer sentiment this year, which is interesting because it was way down. It came down below, what it got to in the height of 2020 when everything was going crazy. Our index of consumer sentiment had been recovering, but it's been really down all year as inflation went up. And I think that chart that you just showed, which I agree, that was a great chart showing inflation adjusted wages, that declining purchasing power. Consumers are feeling that, and because of other forces, it hasn't necessarily showed up in certain parts of the economy, like the labor market, like consumer spending to some extent. But absolutely, that's reflective of what consumers are feeling.
It's the power of the Bloomberg, Kayla.
Yeah, if somebody was running for...
Actually, I should point out, Morning Consult, they have a lot of great data, too, by the way.
I'm just saying, if you're running for office, that's the kind of chart you show, right?
Yeah, exactly. Hey, Kayla Brun, thanks so much for joining us this afternoon. Really appreciate your time. Kayla Brun is economic analyst at Morning Consult. Well, coming up, we're talking to Bloomberg exclusive, a disastrous year for hedge funds. We're going to take a look at Tiger Global's transformation into something that looks more like a VC fund. This is Bloomberg.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one. And through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
All right, here we are here on the final trading day of 2022. We started the first trading day of 2022 with a record high on the S&P 500. Right now, we're at 3805 and change. That's down about 20% or so from that record high. The bear market that effectively kicked off back in the middle of June, that continues to persist. So no matter what optimism folks have for 2023 and beyond, the damage is done. Most of the estimates that we had for the S&P to close out this year were wrong, with a few exceptions, Mike Wilson and a few others who sort of predicted this decline, but even them, they got the numbers wrong, even if they got the trend line right. The big question, guys, going into 2023 is where is that leadership going to come from? Are you going to find it from the Apples and the Teslas and the Amazons of the world? Or is there going to be a new crop of companies? Or are we all just going to be buying, you know, Occidental and
I was just going to say, will energy once
Yeah.
again go into a third year of just outperformance?
Yeah, I'm going to say no. Because we had this conversation yesterday with some people, and I looked back through the data. And it's not to say it can't happen, but when you look at history, you're talking about it would pretty much be unprecedented, at least in the modern era.
But I do feel like it's a different environment going forward if we continue to see that pivot, forgive me for the use of word, to renewables, right?
I'll allow it. Coal is big.
Coal is big.
Yeah, I've been stockpiling.
Well, you talked about it in terms of the commodity. All right.
Yeah.
Are you talking about what you got in your stocking this year?
No, I just keep it in the closet.
Okay, all right.
It works out.
Compressed,
My neighbors haven't complained just yet.
Compressed it enough
Remember
and
when
it'll
Tracy
become a diamond.
Alloway bought like a little thing of oil and kept it in her bathtub? And then someone,
like corralling cats
and then someone informed her that like you actually shouldn't breathe in like vapors from crude oil. And I was like, you know.
All right, some vapors coming from DC.
Can we get Tracy on the phone?
Dead silence.
Okay.
Oh, okay.
Works really well on
I thought it was
radio.
Carol's turn.
I'm going to go to DC. It
Is
is
this
my
what you
turn.
do
I'm
with
just
your kids?
waiting to see if they were
Just treating
done.
me like a child.
No, there's a wine segment at the end of the show. Nobody's been tapping into the wine yet, I promise. We are tapping, though, into some of the news out of D.C. We know we're going to be focused on the markets. We're going to be focused on news out of the nation's capital. Today, we finally, after several years, Democrats have been pushing this for some time. We got former President Donald Trump's tax returns over the past couple of years, released today by the House Ways and Means Committee. What did it show? It showed that the former president was able to use the tax code to minimize his payments. So let's get to it with Bloomberg's Stephen Dennis. Stephen, you know the Democrats have been pushing for this for years. So net, anything, all right, what did we get? We just showed that he's very smart in terms of minimizing how much taxes he pays.
Yeah, I mean, I think, you know, the nature of his businesses, real estate in particular, you can take a lot of depreciation and use that against your taxes, even when your real estate value is going up. You know, he did have a lot of business losses in all of these years. He paid no personal income tax in 2020, his final year as president. And, you know, I think this sort of raised a question. He said that he was going to change the tax code, and it was going to cost himself a lot of money. But there's really no evidence that it did so. Instead, it sort of preserved a lot of the business tax breaks that have allowed, folks with a lot of money and a lot of lawyers and a lot of planning to avoid paying taxes. Though there was no year here from 2015 to 2020 that he paid even $1 million in taxes.
Well, what does it mean for future presidents, Stephen? What does it mean for the way that, there's not any rule around the, presidential candidates or presidents have to actually release their tax returns, but does this actually have any implications or set some sort of precedent?
Yeah, so the precedent since Nixon has been that presidents sort of voluntarily release their taxes, and of course Trump said he would once he wasn't being audited. But one of the things that the committee found was that his taxes basically weren't being audited while he was president, at least for the first few years. And so that's that's leading to legislative efforts by Democrats to force presidents to release their taxes, and at least force these audits to actually happen. That's probably not going to go anywhere with Republicans taking over the House. However, they've strongly criticized the release of these taxes. Trump himself has strongly criticized the release of his tax returns, even though he's sort of bragging about having not had to pay a lot of taxes because he's been able to use assorted tax breaks in the code.
Well, hey, Stephen, one thing, and I think we clearly, I'm not surprised by any, a lot of business folks, right, are just smart in terms of reducing their taxes. We all look for, ways to do that. Having said that, anything in here that shows some kind of conflict of interest, that's something as someone as being the president of the United States shouldn't have done, and that's worrisome?
Well, I think it's kind of in the eye of the beholder. He signed a bill that was comprehensive, that affected his businesses. It affected all businesses. Things like the alternative minimum tax is something that he dramatically scaled back.